a.m. in New York City on this Tuesday, October 29th. Welcome to Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up here, big tech earnings. They're taking the spotlight as Alphabet reports its results after the closing bell. The parent company of Google is projected to show strong revenue and profit growth as the company's cloud computing division gains. Plus, we'll get the latest read on AI demand with AMD reporting earnings after the close. The company's results will provide the latest insight into its attempt to compete with NVIDIA in artificial intelligence processors.
Plus, investors parsing through a slew of earnings before the bell this morning. Results from McDonald's showing that revenue and profit topped expectations, but international stores seeing some weakness. However, analysts and investors are already looking ahead to the fourth quarter to assess the impact of its E. coli outbreak that was linked to the company's quarter pounders. Also keeping an eye on results from JetBlue, D.R. Horton, PayPal, SoFi, and Pfizer, all out this morning.
And investors will get the latest read on the U.S. economy this morning with Conference Board consumer confidence and JOLTS data both crossing the wire. Now, consumer confidence is expected to rebound slightly in October after seeing the largest drop since 2021. Meanwhile, job openings are poised to rise slightly after a surge in the previous month.
Alphabet is due to report earnings after the bell today. Shares, well, they've gone nowhere really for months, trailing Mag 7 peers as investors struggle to price risks confronting the company. Today's numbers will offer the latest insight into the health of big tech. Joining us now for what this means for the broader market, we want to bring in Venu Krishna. He is at Barclays head of U.S. equity strategy. Venu, it's great to have you here on set. So talk to us just about how much is riding on these results. Lots of questions about valuation and whether or not they are a bit too full at this point.
So I think the first part of your question, a lot rides on it. If you think about big tech, which is a collection of 6 stocks, that's been the fulcrum for this market and holding it, not just from earnings, from returns perspective as well. And I think what's interesting is that their earnings as a group is moderating from extremely high levels. So their comps are getting difficult. So if you think what the comparisons are, they were growing earnings over 60% in Q3 and Q4 of last year. That's what you're comparing with. And I think the earnings are moderating, but still are expected to settle in the 20s, which is extremely healthy. But I think the biggest uncertainty, or at least caution I have, is what do you pay for those earnings when they're moderating? And when they've entered a phase in which a significant amount of uncertainty around the timing of monetization of AI spend, the sheer scale of AI spend, and the historical experience in the last 10 years when this big tech or group has had a situation of high capital intensity in terms of spending and moderating earnings growth. And multiples have corrected reasonably strongly in those periods. So that's a setup we have right now, right? So as we're entering, they're trading at around 30, 31 times. I think that's on the high end. Their peak this year was 34. During the summer correction, they went down to about, I think, around 27, which is, 20% correction. And now we bounced back, right? Now, that said, their earnings are still rock solid.
Yeah.
They're highly, highly profitable. So, and if you look at this third quarter, what's amazing is that earnings numbers have been revised down quite sharply. For big tech, it's held steady. But for the rest of S&P outside the 494, it's actually gone down, right? Meanwhile, subsequent quarters have been left unchanged.
Right.
So I think so we are quite optimistic, but I think a lot rides on big tech to at least create that base of stability, even as they are moderating.
So much of those profits that you're talking about, though, that's been built with search in mind, with digital advertising in mind over at Google or over at Alphabet. For decades now. But we're seeing a rapid shift, and it's both in the spending that they're putting forward now towards AI, but also in how quickly search itself is changing, and the top results that you're seeing could be more AI generated than before. And so that takes out perhaps 33% of the above-the-fold advertising that they would have been able to run. How significant of an impact do you think that could be?
You know, there are a lot of these moving parts, and to be honest, the subject matter experts in those areas will be able to opine more closely. But I would say that if you take the big picture right now, all these companies have tremendous horsepower in terms of their capability and ability to execute on AI. Don't forget, when you talk about Google, they were at the forefront of the whole AI phenomenon well over a decade ago, right? So I don't think, you know, I would be that negative that they're going to lose their core business, because one is these businesses collectively, if you think of the big tech, is a very broadly diversified business. It ranges from consumer devices like Apple to cloud services to digital advertising to retail like Amazon. It's a very broad spectrum. And that's the reason why, when you look at the correlations between these 6 stocks, it's only about 40 to 50%. It reflects the breadth and range of the businesses. So I would say it's a risk, but there's no way that you can count them on. At the same time, you recognize that down the line, and that's maybe 2 to 3 years from now, there will absolutely be new business models created. There'll be some who will be out of business. There will be some companies who adopt AI just to stay where they are. In other words, that will be margin negative for them, right? So I think there's a whole bunch of changes going to happen. And the biggest uncertainty, or the biggest thing we are looking for, is will AI plus the combination of cloud lead to a significant enhancement in productivity in America, right? If you look at the last 3 to 4 decades of tech cycle in the US, starting from the PC cycle to internet to mobile devices, and now you're in cloud and AI, productivity has increased meaningfully. But it's also important to note that with each subsequent tech cycle, productivity gains have declined. So the question is, does a combination of AI and cloud accelerate the productivity? Right? There's a reasonable chance it happens, but we don't know. I think it'll still take about a couple of years to see in the application stage what happens.
So then, Venu, I guess given all that, the hype then surrounding AI, it sounds like it might be a bit overdone at this point, just given the return on investment, the fact that that might not come for years to come. If we do see these big tech earnings over the next several days just meet expectations, not necessarily exceed them by a substantial amount, what does that mean then for the broader market? How big could we be seeing a correction as a result?
I would say that, so that's a very good question. And you know what, everybody keeps focusing nowadays is on broadening, right, of earnings, and how big tech moderating is not necessarily bad. So that's the half glass full kind of situation. The reason I say that is historically, when big tech multiples have corrected, correlations have increased with the rest of the markets. In other words, you're not immune outside. And don't forget that, just like I told you in 3Q, it's the numbers for the rest of S&P which have been cut. And for big tech, it has been left relatively unchanged. So to your question of if they just meet expectations, that's not good. So if you look at last quarter, collectively as a group, they beat earnings by about 5.5%, 6%. But for the 4 quarters before that, the range was anywhere from 8.5% to 14%. So I think the scale of surprises in the 5 to 6% is reasonable. Anything less than that, I'll be disappointed. Anything above that is phenomenal. They will be back in complete control compared to especially the rest of the market. So I think that's where the rubber meets the road in terms of their mature businesses, which you were pointing to, Brad. How well they're holding up. And that's been a mixed bag, right? For Amazon, for example, the retail has been really reasonably strong. For Google, the YouTube, I think, was weak, but search was relatively strong. For Meta, digital ads were great. So it's been a mixed bag where some parts have done well, some parts not that well, right? So, but all these companies are telling you that this AI phenomenon is so huge that none of them is going to back away from the spending they're undertaking right now, because they do not want to be left out of the race.
Where do you believe the deepest value opportunity is within tech, especially considering the Mag 7 and the thesis that has really been lighter fluid for them, which has been AI, which is what we've been discussing here this morning?
Yeah. So biggest opportunity, you mean broadly within the tech space? I would say that for big tech, this group of 6, my best approach to them is to have a market weight in it, because the fact that the correlation between them are 40 to 50% means at any point in time, if you're bold enough to be a stock picker and you get it right, it can work very well. But I can tell you that a lot of people have got it wrong. There were people who were short Apple because of declining fundamentals. But then Apple's prospect changed dramatically once the market woke up to the fact that they probably are in a good position to implement AI through their apps because they control the mobile device market, right? So I would say that that group is something which I am hesitant to try to take individual bets. But as a group, it's a great place to be in. I'm worried about the multiple you pay, right? 31 times, I think is above my comfort level, right? Not dramatically so. But what I would argue is that if you look at outside of big tech, if you look at the S&P 494, so there are different ways or themes in which you can take to take advantage of the fact that you don't want to be so concentrated in 6 stocks which are controlling 30% share of the S&P, for example. And I think one way to think about it is we undertook an interesting exercise, I think roughly 6 months ago, where we said, let's look at why big tech is doing so well. And we looked at 5 or 6 parameters in which they were hitting it out of the park. And we said, let's try and replicate these sort of metrics outside with the eye on diversification, knowing fully well that you can approximate it but not replicate it, right? And so that basket of stocks of roughly 50 odd stocks actually has been doing very well. It continues to close the gap with big tech. It's up around 23, 24%. And big tech is up 40%, right? But it's doing much better than the rest of other names in S&P. So I think you have to be creative in this market and look at themes in specific stock-specific areas to sort of get a exposure above and beyond the big tech.
Venu, we gotta go. You were talking about S&P 494 versus the 493 that we're talking about, and Magnificent 7 that we were talking about versus 6. Which one have you already booted out?
Well, we've never considered Tesla as part of our.
All right.
When we say big tech, that is clearly in a different domain of auto, sort of with the tech leaning and other stuff. But Tesla was never a part of our big tech definition.
Venu, great to have you here in studio with us today. Venu Krishna of Barclays, thanks so much for taking the time ahead of the opening bell. Investors closely watching Friday's jobs report for a read on the Fed's potential next moves, but the report might have a few factors making it a little more distorted. It's the focus of today's morning brief, and with us to discuss, we've got Yahoo Finance's very own Josh Schaefer. Josh, what do we know about the different forces that are going to be playing into these data points and how the Fed might have to consider that?
So we've been talking a lot about all of the hurricanes that have been hitting the U.S., right? How that caused a shoot up in initial jobless claims, people for filing for weekly unemployment benefits over the last month. Well, they also do the employment survey during those weeks, right? And the employment survey happened during a week that was heavily distorted by hurricanes, also a strike happening at Boeing. So the result of that is you end up with consensus now projecting the U.S. economy added 110,000 jobs in October. For perspective, that would be the second lowest number we've seen this year, close to one of the lowest numbers we've seen all year. And really, Brad, what that says to me, though, when you look through it, the real question that we always ask with the jobs report is what does it mean for the Fed, right? And about 2 weeks ago, I was at a speech from San Francisco President Mary Daly. She was asked specifically about this twice. And I thought what she said was interesting, which was essentially, well, it's never just about the jobs report, and it's never about one print. And I know we like to make it about one print because it's exciting. We're going to play it up on Friday, and we should. But it's about actually what they always say. It is about the totality of the data, right? And if you look at what a lot of other labor market indicators have been seeing, we're going to get one here at 10 a.m. with JOLTS. Hiring's been coming down. Quits have been coming down. You're looking at a labor market where it's harder to find a job. You look at the Fed Beige Book last week. That was what a lot of the responses were there too. So you're seeing overall a little bit of weakness. So if you see that weakness on Friday, that's really kind of in line. But you're still seeing general economic strength. We're expected to see GDP come in at 3% for the third quarter when that gets released tomorrow. So you combine those things, you're still kind of in soft landing zone, and I'm not sure what could come on Friday that makes you all of a sudden go from should they cut 0 or 25 to they should cut 50? Because again, the read through here is the print is going to be weak, right? Can it really be weak enough that it moves the Fed to 50? I don't think so.
Yeah, and that's not really even based in the projections at this point, just in terms of what traders are anticipating. Josh, I'm curious what you've made of this recent discussion, I guess we can call it relatively recent, of the last couple of weeks, that maybe the Fed isn't going to cut at all, and how much that matters and what that means just in terms of that longer term trajectory. Any insight there?
Well, you've already started to see the market move going into next year, right? Like the move that we've seen in the 10-year Treasury, and as far as rates being, we'll use the phrase higher for longer, right? The higher for longer is in 2025. The market's already priced out one less cut than we were pricing in 2 weeks ago. The stock market's still near record highs, so that gives you a feeling for what investors felt about that move over the last 2 weeks. The S&P still kind of chugged higher, right? I think the question largely is, when we think about the no cut scenario, maybe the jobs report could sway it if it was super, super strong. But again, I actually asked, to go back to that conversation I had with Mary Daly, I asked her specifically about that. I said, so what about the growth data? There's this argument from at least some Wall Street economists that you're going to get a no landing scenario and growth's too strong. She said, when you look at things like that beige book and those checks, it's enough weakness to still be worried about. Remember, they're talking about a little bit of labor market growth, not a lot of labor market growth, and it's still harder now for people to find jobs than it was a year ago. That leads to a little bit more easing in the pipeline before I think you get to the point where they're debating, okay, do we skip a meeting? Do we skip 2 meetings?
All right, Josh, thanks so much for teeing up some of the data. Of course, some of it coming during the 10 a.m. hour here this morning.
Oh, yes.
Jolts.
Get ready.
Everyone's favorite.
Very own
Let's
Bradley
go.
Smith is going to be breaking it. Josh is going to be writing it.
can't wait.
The all-star team here.
Fully covered.
First-time Catalyst correspondent. Can't wait. Guys, coming up on Morning Brief, we count you down to the opening bell on Wall Street as investors digest a big week of earnings. Plus, we dive into the results and speak to an analyst next on McDonald's Q3 report. And later on this hour, we'll bring you more analysis on Pfizer as the company smashes past estimates. All that and much more coming up on the Morning Brief. Good morning. You're watching The Morning Brief, brought to you by Invesco. Now time for some of today's trending tickers. You could scan that QR code below to track the best and worst performing stocks of the session. There it is, with Yahoo Finance's trending tickers page. First up here, let's go to the skies. JetBlue reporting a narrower than expected third quarter loss, but forecasting falling revenue for the current quarter. Still, the company says it remains on track to hit its full year targets. The company also announcing new plans for some of that extra leg room for seats to meet the growing premium travel demand here. Shares right now down by about 6.4%. I think investors are just increasingly pricing in how much that it's going to take in spend in some of those capital expenditures in order to pivot to premium here. It's not an easy task at all. And I think they're right to be doing this. It's just how quickly this is expected to pay off, especially thinking about their hub here in New York City, how the concentration of wealth would be clamoring for even more premium options out of that hub to some of the key cities that they service here. And I think that's where perhaps we'll see a little bit more of that early lean in originating and emanating from New York.
Yeah, and I also think the big question going forward is also just what exactly that timeline of the recovery looks like, right? You talk about all the external factors at play. We know JetBlue has been dealt two pretty significant blows or setbacks, I think you say, just in terms of the ruling, in terms of the acquisition of its Spirit Airlines that was blocked, and then, of course, the breaking up of the joint venture with American Airlines. So under their new CEO, lots of questions just about what exactly the plan looks like going forward. JetBlue not alone, just in terms of reassessing and scaling back some routes that aren't as profitable as others. And it's almost a similar tone to what we heard from Bob Jordan, Southwest CEO, who joined us yesterday, talking about some of the perks that they are adding, the strategy shift in order to really try to capitalize on that more premium traveler. And because we know where the margins are, we know that it is paying off, especially when you compare some of the performance of these underperformers or budget airlines versus some of the larger names like United up on the screen.
Yeah, I'll be excited for the extra leg room. I'll take it every day.
Right?
Yeah.
You got to pay up for it, though. Are you willing to do that?
We'll see.
All right, let's take a look at D.R. Horton missing estimates for fourth quarter earnings and revenue. The home builder also forecasting 2025 revenue and home deliveries below expectations. The company saying mortgage rate volatility and also uncertainty are keeping some buyers on the sidelines. We've really seen that play out in the activity here this fall. You're looking at a drop, though, of just around 13.5% here ahead of the open. You would think the election uncertainty, just anecdotally, I've been hearing that has been playing also into some of the, sluggish activity that we have been seeing in the housing market. And of course, the question going forward, just how much further improvement, meaning lower rates, we could potentially see in the mortgage market on mortgages, and just the extent of what that needs to be, the level in which it needs to drop to in order to really spur extra activities. And I think it's almost going to be a wait and see type of situation until we get to that spring selling season.
Yeah, spot on. Here's that sexy stat for you from the home building market. Nearly a quarter of prospective first-time home buyers are holding off until after the election. That coming from a Redfin survey here. You think about the backlog of homes as well here that the company is trying to move through. And as of the end of this quarter, we should note as well, the company had 37,400 homes in inventory, of which 25,700 were unsold here. Now, 10,300 of the company's unsold homes by the end of September were completed, about 1,100 completed for greater than 6 months. So this really comes back to some of the both rate side, but also just buyers who are out there right now, and at least according to this Redfin survey here and some of the data there, personal finances and timing are the most common reasons cited for delaying a home purchase. Other reasons including future interest rate cuts, immigration policies, and affordable housing initiatives as well. Those are all playing into the psyche for some of the first-time home buyers out there who are waiting until after the election, coming back to your point earlier. Finally here, let's go to the golden arches. McDonald's. Shares there, you're seeing them tick lower just slightly here as the fast food giant sales in the third quarter falling short of expectations as weak international sales weighed on its earnings report. To discuss what's next for McDonald's, we have Sean Dunlop, who's the Morningstar analyst. Sean, I want to get your read through here on the Arcos Dorados here, McDonald's, of course, not to be confused with their Latin American business, obviously, but the read through, especially as consumers are looking for more value, even when they are eating away from home.
Yeah, I thought it was actually generally a positive quarter. I was a little bit surprised by the market reaction. As you point out, the international business was a bit light, and this was the company that a lot of people thought might actually top earnings estimates within the industry, which obviously didn't happen, with results coming in roughly in line. I still thought it was positive, though. In the United States, we saw comparable sales increase 30 basis points. That's a pretty sharp improvement from a 70 basis point decline a quarter ago. That was traffic driven, which is really encouraging, and they actually gained share with that low-income consumer for the first time in about a year. So from McDonald's perspective, that gap that we see relative to industry traffic and industry check is the highest we've seen since the first quarter of 2023. I think that's the point that shouldn't be lost as investors consider the forest and the trees. They are trading margin for that. That has a little bit of a downside. If you look at company-owned stores, margins clocked in a little bit below 13%. For the full year, we project store-level margins down about 120 basis points. Looking forward, though, guest-led growth is a lot more sustainable. It looks to me like McDonald's has righted ship here.
Sean, I mean, what is front and center, though, on people's minds right now? Wasn't reflected in this quarter is the E. coli outbreak, just what exactly that looks like, the pressure it's going to have on McDonald's results this current quarter. What do you think?
Yeah, I think they handled it as well as you could possibly ask. So typically, this happens every few years in the industry. For McDonald's, you've got 42,000 stores, you operate in more than 100 markets, you've got myriad suppliers. These happen periodically. It is the first time it's happened for them in the United States in 40 years. The good news is that this was a supplier issue, an ingredient issue, and not a process issue. So we don't think that it's likely to repeat. They had alluded to traffic trends really starting to inflect positively at the start of the fourth quarter. And then obviously they were negative over the past week as the news about this outbreak broke out. So as we look back at sort of historical context, we expect this to be maybe a low single-digit traffic impact in the fourth quarter. Fortunately, we think this is going to be contained, given that they were able to very quickly isolate the source. They're very transparent about the process. And given, again, that it was an ingredient issue, not a process issue, we think it's pretty unlikely to happen again.
Should we expect more value meals from McDonald's as all of the kind of quick service restaurants, fast food are competing to make sure that they can not just woo people and customers with rewards, but make sure that there's value in every single purchase that they are making and engagements that they do have? And what does that net out for some of the margins at the company?
Yeah, as we alluded to earlier, it does have a negative margin impact, and we should expect a little bit more value offering. So when you see restaurants struggle with comparable store sales, kind of the two levers that they have to pull are menu innovation and promotions and advertising. We've definitely seen plenty of both from McDonald's, should expect to continue to see plenty of both from McDonald's. That $5 meal deal was really effective at bringing back lower income consumers to the store, at improving the firm's value perception, which had started flagging a little bit. We expect a lot more of the same moving forward. You definitely see that in the margin line, but as long as you also see that in the traffic line, that's just fine as far as we're concerned.
Sean, what do you think is the number one biggest challenge outside of maybe E. coli outbreak? I don't even know if you would say that, but what is the biggest challenge here for McDonald's as you look ahead to 2025?
Yeah, I really think it's price competitiveness. So you think about 30 basis points comparable store sales growth in the U.S. outperforming the industry by a wide margin. That's very concerning. Right now, we live in an environment where wage growth is consistently higher than expected food cost inflation. For restaurants, that means that as the quarters progress, they're growing less and less competitive from a price standpoint with grocery stores. And we're seeing consumer traffic continue to favor that cheaper grocery store channel. The difference on a per meal cost basis is a little bit less than $5. It's the highest it's ever been. And consumers, particularly low-income consumers, continue to migrate. So that's probably the biggest concern moving forward.
All right, Sean Dunlop, great to have you. Morningstar's analyst, thanks so much for taking the time to join us here this morning. Coming up next, we've got the opening bell on Wall Street. We'll be right back. Counting you down to the opening bell, you're watching Morning Brief brought to you by Invesco. Let's do a quick check of the markets here. The final seconds before that bell rings down on Wall Street. You got futures pointing to a lower open, at least for the Dow. You're looking at a bit of pressure here. So we're expected to open in negative territory. On the flip side, you are seeing a bit of strength. I don't even know if you can call it that. Slight gains maybe here for the NASDAQ at the open as we kickstart a brand new trading day. Again, this week is going to be a critical test for the markets. We've got a number of the Mag 7 companies set to report. Alphabet kicking that off tonight here for this week. We heard from Tesla last week, obviously blowout reports, really upping the expectations maybe for some of these other Magnificent 7 names. So again, that will be a huge test for the market. And then we have a very important econ data coming out later this week, another read on inflation, also that very important jobs number that will be out on Friday before the bell. But let's take a look at where things stand here this morning. You're looking at a bit of a pullback here for the Dow, off just about nearly 200 point slide here. You've got the S&P 500 also pulling back just a bit, still holding above that 5,800 level. I also want to point out some of the action that we're seeing beyond the equity market and pull up that move higher that we're seeing in the 10-year yield, up another 5 basis points here. The highest level that we see now above 4.3, highest level that we've seen for the 10-year yield in just about 3 months. Also, Bitcoin getting some attention here this morning, really over the last 24 hours or so. We're now above 71,000, a threshold we haven't seen in some time here. So that, of course, will be an important trade to keep in mind throughout today's trading day. Taking a look at the sector action, what we are seeing on an intraday basis, not too much green on the screen. You got technology, the only sector there holding on to slight gains. We'll see whether or not that changes ahead of Alphabet's results later on tonight. But the rest of the sectors are in the red. You're looking at utilities, the worst performer, followed by consumer discretionary and materials as we shake out some of that leadership here, underperformance that we are seeing inside the sector action. Then real quick, just to take a look at the Dow components, a number of components of reporting before the bell this morning. We just heard from McDonald's, although we are seeing a bit of pressure here. Actually, the stock now moving to the upside. So we just heard from Sean Dunlop from Morningstar saying he was a bit surprised maybe at the reaction that we are seeing in this stock, why we aren't seeing a bit of more excitement following those results. But again, you've got Microsoft and JP Morgan slightly holding on to gains. But in terms of some of the other tech names, Apple and Amazon there just around the flat line. Jared?
Well, thank you, Shauna. You and I are watching a lot of the same markets. Let me start at the NASDAQ. I want to go back to the major indices here. That's Bitcoin, but here we're going to go to the NASDAQ. Looks like it's trying to break a 3-day winning streak, but I want you to focus on the year-to-date chart here. Still up about 23%, just inches away from another record high. It has been consolidating. Looks like it wants to break out, but it has not done it just yet. And a number of other markets and individual stocks are kind of looking the same way, like they want to break to the upside, just looking for an excuse. And then to talk about the S&P 500, which is very close to record highs also, and up 21.8% year to date. This now that we are entering November, this is the best 6 months of the year for stocks. And we are coming out of the worst 6 months for stocks. That would be May through October. And if you're scratching your head saying, well, this wasn't really a bad 6 months for stocks, that's because it was the best worst 6 months for stocks going back to the 1950s, right at the top there. So I hope that wasn't too confusing. Just want to circle around to the 10-year T-note yield. Yeah, 4.33%. It has risen so much over the last month. Goldman Sachs saying it could now start to weigh on equities. Really interesting because we have equities at or close to record highs. So the thinking is if they're able to break through, maybe yields pull back a little bit. We'll have to see how the whole dance plays out. Want to focus on the Mag 7 real quickly because the Mag 7 are actually up double the NASDAQ. You can see most of the components in the red here. I'll just go to Alphabet real quickly because this has been consolidating in a nice inverse head and shoulders pattern here. Looks like it wants to break out of its own little base there. So lots of markets, I think, are just trying to break out. And finally, we mentioned Bitcoin before. Got to show you Bitcoin because that is up to the Rubicon. 73,000 or thereabouts is its record high, and it's trying to make a move there right now. So we'll see how that plays out as well. Guys.
All right, Jared Blickry, thank you so much, teeing up today's trading activity. Well, consumer-facing companies reporting results this morning. JetBlue, McDonald's, Royal Caribbean, they're all reporting. And our next guest is positive on the consumer discretionary space. Joining us now is Eric Friedman, who is the U.S. Bank Chief Investment Officer here. Eric, great to have you here. So what do these reports, I suppose in aggregate, tell you about the consumer right now and where they're prioritizing spending, even within some of the discretionary dollars?
Yeah, it's a great question. I mean, basically, the consumer is in a couple different places. The middle income and higher income consumer is still very strong, still looking at experiential spending, and that's something that we don't think is going to go away. We are seeing a more choiceful lower income consumer. This is true across both bottoms up research we do as well as the top down data. And I think that what that means is that really that the swing factor, if you will, for earnings for the rest of this year and early next year will be middle to upper income consumers. Will they hang in there? That's really what we're spending our time focused on. We also think the important thing to pay attention to is CFO spending trends. We'll obviously hear a lot about that given tech earnings this week and next week. Those are the two biggest things we're focused on for clients right now.
Eric, are you advising clients to make any adjustments then at this juncture? Is this more a wait and see type of mode?
Yeah, we've really gone into this very chock full of macro events, week and a half neutral risk. And so it doesn't mean that we're kind of the two-handed economist, if you will, but we're really focused on a couple things. Number one, making sure we're picking up cash flow. That's something that with yields as high as they are right now, fair value for the 10-year, we think is probably closer to 4%. But technically speaking, we're not looking to add duration right now. We think you can pick up cash flow in areas like master limited partnerships, get a little bit of an inflation hedge on that way. We do think that the one thing we'd emphasize for clients that have shied away from tech is to get back involved. Again, that's a space that we continue to see spending more on the B2C side, as well as a pronounced input on B2B. So that's a space that we still like quite a bit, especially cyber. We also like what's happening within AI writ large. Of course, it's a very cliched comment to make, but we also think that that spend is not going to go away. Companies are looking to get bigger, stronger, faster. And so CFOs spend on tech, we think, will be a theme for the next couple quarters.
How long tail do you think that spending is?
I think it's at least 3 quarters. I think that if you look at really what we're seeing across both business to consumer, plus probably more importantly, business to business. You look at some of the big OEMs within chips, they've only had a couple customers with their orders filled. There are a lot of entities, a lot of countries, a lot of companies that are looking to increase their spend, especially on higher end chips. And so that backlog, we think, doesn't unwind anytime soon. Again, important to see what we're seeing from some of the secondary players within the chip space. But again, that backlog, we think, is at least 3 quarters out. Again, barring any massive surprises in the election, we think that CFOs will keep spending. The other thing to really focus on is buyback season. That's something I think is probably undercovered. We are almost into November. And if you think about what CFOs are thinking and considering into the tail end of the year, many may have missed the trade, if you will, and have some dollars left to spend on the buyback front. That could be another push higher for equities as we get past this election noise.
How big of a catalyst do you think that could be, Eric?
I think it could be significant. I mean, again, it's not necessarily a pan-market phenomenon, but if you look at, again, companies that have been a little bit reticent, think about places like financials, places like technology that have been a little bit wary on regulatory and also on what the election may look like. Once we clear at least some level of clarity, not saying we're going to have complete clarity next week, but that could be a catalyst into the back half of November as well as December. We think especially taxes, which we can't bypass as being a countervailing factor that may offset that. If we do see a mixed election outcome, concerns on taxes may pull forward as less of a 2025 phenomenon solely, but also something that investors may want to address this year as well. So again, a lot in the soup, if you will, but we certainly think that the bias is probably higher as opposed to lower.
Eric, as you're mentioning the election, it brings to mind that even as we're in the middle of this earnings season, it could change the tenor of how companies who realize that they may be impacted by one party or another's prioritization of their industry, their tenor around how they're looking at their forecast may significantly change as well. So I wonder, from your estimation, how largely the election could drastically shift some of the earnings growth profile, even as we go into and are looking at 2025.
Yeah, I think it's a great point. I mean, if you look at sort of the pan market issue, is what happens to the cost of capital. We've had a significant increase, again, 65 basis point increase in the 10-year and the 20-year since the last Fed meeting. That wasn't necessarily in most people's bingo cards, but that impacts all CFOs. They are thinking about their cost of capital, which has invariably gone higher. The other thing to think about is, again, regulatory for some of those key industries I mentioned. We're going to have a lot of information in the financial space as well as technology. Healthcare is something that's actually really been impacted by China in particular. And so there's a little bit of an overhang that we think could work itself out if we get a more middle of the road election outcome. So I do think, again, not to be perpetually glass half full, but there are some, I think, hesitancies across CFOs that may be released as we get deeper. Those would be the sectors we're most focused on: financials, healthcare, technology. Those are probably the areas that we're most focused on, that being a bit of a lift from the overhang standpoint.
All right, Eric Friedman of US Bank, thanks so much.
Thanks.
Coming up, a blowout quarter for Pfizer. We're breaking down the results and looking ahead to other pharmaceutical names reporting this week. You're watching Morning Brief. Welcome back to Morning Brief, brought to you by Invesco. Pfizer blowing past third quarter earnings expectations, raising its full year guidance this morning. Revenue increasing 31% from a year ago, boosted by sales of its antiviral pill Paxlovid. Joining us now, we want to bring in Krish Ishibutani. He is a Goldman Sachs senior biotech analyst in global investment research. Chris, it's great to have you here. So let's talk about, we want to get to a lot with you, but first let's focus on Pfizer. The news out this morning, we're seeing some excitement play out, once again raising its guidance for the year. What's your first take at the results?
Yes, good morning, Shannon. Pfizer's strong print, but clearly it was driven very much so by the COVID-19 complex, in particular, as you mentioned, Paxlovid, the therapeutic. That was a very important part of the upside relative to the expectations, both in revenues and earnings, and also the raised guidance. The balance of the business is doing well, but is still very much a work in progress.
And so with that in mind, I mean, it seems like Pfizer saying something differently than some of the other competitors out there that are saying, okay, COVID is not the same kind of long tail that we may have expected to be. But for Pfizer, it seemed like that was a little bit different. And so if that is the case, how long can that continue to show up in their financial results?
Yeah, no, that's the key question, right? And I think what is the level at which things will begin to stabilize? It's been very clearly difficult to predict going back several years. Obviously, even the whole trajectory of the pandemic, the vaccine, very important role, and Paxlovid as well, a very effective therapeutic, but gauging the demand and the revenue cycles has been very challenging. Clearly, they did stronger than they had previously expected, raising that guidance. But I think investors are going to be trying to, again, focus on the base business, noting that we're probably going to get to some level of core COVID complex vaccine and therapeutic revenues. And hopefully we'll be able to better define that in the 2025-26 time period. Clearly, these results indicate that there's still a bit of volatility and it remains difficult to predict.
Yeah, and Chris, given that, of course, the battle with Starboard has been front and center when it comes to Pfizer. They've been very critical of a number of things, one of those being the spending spree, as they called it, under CEO Albert Bourla. They've talked about the fact that he's done $70 billion worth of deals. I'm curious from your perspective, the spend of that magnitude, do you see that? Is that problematic, do you think, for Pfizer?
So two items there, right? I think the COVID complex revenue trajectory gave them tremendous access to resources. And with that, they were able to apply that to thinking about how to rebuild the post-COVID revenue profile for the company. Now, they did focus a tremendous amount on M&A, and they did quite a few acquisitions. Seagen was a very important cornerstone of that. There were some additional deals, however, which have included some subsequent results from pipeline and commercial products that have not quite worked out as originally envisioned. That return on investment component is what is, I think, being questioned. In terms of the overall operating expense profile, the company has been very actively engaged in a clearly announced cost realignment program. And we're seeing those results over the last several quarters now, where the operating expense levels, spending on SI&A and R&D has come in below expectations. So it's a combination of factors here, but that, again, investment in the opportunity, the capital allocation on the forward had been considerable on the M&A front, and we're seeing more cross currents and mixed results in terms of what those acquisitions are doing to contribute to the forward outlook. I think that's where the nexus of the debate is.
Yeah, and Chris, one of the other things that Starboard's Jeff Smith has said that stuck out to me was questioning Bourla's role at the top. And he said, quote unquote, it could make sense for Pfizer to replace Bourla as CEO. Pfizer without Bourla, what does that look like?
So any pharmaceutical company naturally has the titular head of the CEO, but Pfizer has in front of it the opportunity to make very important announcement, and that is of the head of R&D. At the end of the day, biopharma, the industry is driven by innovation. The point person there who can play a very important role in being a voice and strategist of defining the pipeline and the growth outlook, I think is going to be essential. They mentioned in their press release this morning that they are quite advanced in terms of their search for that. So I think that becomes really a focus of attention for investors. The voice that defines where the strategy is going to be on the innovation front, which will then be a very important guide to how Pfizer can progress over the coming several years.
To what extent does that R&D and that investment need to have within it a prioritization around GLP-1s and weight loss drugs?
That's clearly the focus of attention of investors. Across the pharmaceutical industry, the GLP-1s and obesity have been a very transformational kind of perhaps more than once in a generation kind of opportunity. Pfizer has been consistent in their declaration of being interested in being involved in that realm. Again, has had more mixed results here. What was interesting about today's update, they do have a lead asset, danuglipron. We're waiting for once daily dosing information. However, they finally did disclose some additional pipeline candidates. That's sure to be a topic of conversation during the earnings call coming up. I think investors have been reserved in terms of their level of expectations of Pfizer's ability to compete commercially these pipeline assets, and the clinical data, not just from them, but obviously from other players who have entered into the space, are going to be very closely watched.
I was waiting for somebody to pronounce danuglipron for me here. Chris, thanks so much. Appreciate the time here this morning. Chris Shubhatani of Goldman Sachs. Thanks so much.
Thank you.
Coming up, everyone, we're taking a look at Yahoo Finance's trending tickers. That's next after the break. You're watching The Morning Brief, brought to you by Invesco. We're taking a closer look at some of the trending tickers this morning, and we're doing it in 30 seconds a piece here. Let's start with Apple. Right now, we're taking a look at shares of AAPL, lower 0.3%. The tech giant exported nearly $6 billion worth of India-made iPhones from March through September, and this comes as Apple pushes to expand manufacturing in India and reduce its reliance on China here. It's been aggressively focused in on this region, of course, in recent years, bringing to the market its first retail footprint in that country, and then also trying to make sure that they can woo some of the customers, perhaps grow out their install base as well there.
All right, let's take a look at Boeing. Another day, another headline coming for this company, raising $21 billion in its share sale here. It was an expanded public share sale. They're doing this to avert a potential credit rating downgrade to junk. You're looking at slight gains here, up just about 1%. But let's talk about the significance of this. We know Boeing has been under a tremendous amount of pressure, obviously a number of issues with their aircraft. The latest big issue or challenge that they are facing is the labor strike that they are seeing from their machinist union. That is now in its 7th week. It has really crippled the manufacturing of the jetliner. So, of course, going forward, lots of questions about liquidity. And this is going to give them a bit of a cushion.
Absolutely. And lastly here, let's talk a little VF Corp. VF Corporation shares, they are rallying. The North Face owner reporting better than expected second quarter earnings, hiking its guidance for its next quarter as well. Shares, my goodness here, they're on the mountaintop. They're up by about 28% here on the day as we're taking a look at the shares. And of course, this is as a lot of the analysts are trying to figure out, all right, looking out from here, and this report specifically, I think UBS saying that the results are getting less bad. So that's good, and perhaps a turning of the page, at least in the near term, and getting back into some favorability with some of their brands, especially among those all-important Gen Z purchasers out there.
Yeah. And tomorrow,
guess what?
Go for it.
Yahoo Finance going to be speaking with VF Corp CEO. Thanks for flagging this. I missed it. That's going to air Thursday. You don't want to miss that at all.
We're going to have more on that.
Even more. All right, we've got a little bonus one here for you today. Ford shares, they're plunging, seeing their biggest drop since July after the automaker guided to the lower end of its full-year forecast in its third quarter earnings report out this week. To discuss what's weighing on Ford, we've got Yahoo Finance's very own Pras Subramanian. Pras, what do we know?
Hey, Brad. So, Ford, they beat on revenue. They matched estimates on earnings with an adjusted EPS 49 cents a share. But they lowered that full-year profit guidance, citing two reasons because of that, limiting their earnings power: warranty costs and supply chain issues. Suppliers impacted by those hurricanes, so that was sort of hurting their ability to create a production with their trucks. Means full-year adjusted EBIT went down to about $10 billion from their prior forecast of $10 to $12 billion. Meanwhile, GM is up to 3 times this year.
Yeah.
So that's sort of what they say to play here, and you're seeing that with the Ford shares down nearly 10%.
Is Ford going to be able to catch up? You stack up their earnings against GM, you stack them up against Tesla, obviously the leader right now in the space. I mean, ultimately, can they compete in this space, do you think, longer term?
In longer term, perhaps. I mentioned GM, they upped their guidance 3 times. Now they're at around 14 to 15 billion adjusted EBIT for the year. That's almost 50% more than Ford. I mean, they don't have that much more volume than Ford, but they're so much more profitable. They got the right product mix, good ATPs or average transaction prices, like not that much in terms of incentivizing. Yeah. And then also they've maintained their supply so that it's not so much you're pushing so much to users, right, to buyers. Stellantis, on the other hand, total mess. Yeah. Revolving door with CEO level and C-suite executives. Cars like the Jeep with their crown jewel and Ram pickups, they're not selling that well, and they have to discount heavily. And I was going to ask you, talk about Stellantis, Dodge. How many cars do they have to offer?
How many?
Yeah, like how many models?
Stellantis, I'm going to go with 4.
Well, Dodge in particular has 2 models, the Hornet and also, the Hornet and the Durango. Chrysler has 1, the Pacifica minivan. So these brands are sort of almost dying here for Stellantis. And then you mentioned Ford. They're in a better spot.
Strategy?
Well, the strategy might be to start getting rid of some of the brands for Stellantis and focus on Jeep and Ram. But back to Ford. They have a good mix. They have good hybrids, but the question is, do they have the full product mix to compete against GM? I don't think that they're quite there yet.
I mean, let's not forget they had the #1 selling car, the pickup truck in the U.S. for decades.
Right.
And so now it's just a shift of strategy and figuring out what's going to woo consumers from this.
Well, they don't have an entry-level car like an Equinox, right? They just have trucks and SUVs.
Yes, differentiating factor. All right, Pras, thanks so much. Let's take a look at the market here, just about a half an hour, 26 minutes into the trading day. You're looking at, I was going to say losses across the board, but the NASDAQ just flipping above the flat line. You've got the S&P off about 0.1%. The Dow off its lows of the session. Much more coming up next on Catalyst. I'm Shauna Smith, and welcome to Catalyst. We're 30 minutes into the U.S. trading day, and let's get to the three catalysts that we're watching this hour. First up, we bring you the latest read on the U.S. economy with job openings and confidence numbers ahead of that all-important payrolls report this Friday. Plus, we'll take a deep dive into big tech earnings and AI with a preview on Alphabet and AMD's results, both reporting after the bell today. With 1 week until the presidential election, we will speak with the CEO of cybersecurity company Check Point and get his read on deepfakes and disinformation ahead of the vote.
Some breaking economic data crossing the wire right now as we're taking a look at JOLTS job openings and labor turnover survey for the month of September 2024. The number of job openings little changed, 7.4 million on the last business day of September. And the U.S. Bureau of Labor Statistics, the BLS, also reporting that hires were little changed at 5.6 million. Also here, further in the data, total number of separations, 5.2 million. And within separations, you had about 3.1 million quits quits and layoffs and discharges that came in at 1.8 million. Now that was also changed little here as well. And so all of these things considered, we're taking a look at the market reaction. Right now, you're seeing the U.S. major averages largely where they were coming into this print. The NASDAQ just barely higher, holding on to some gains. But the Dow and the S&P 500 still in negative territory fractionally right now, Shauna.
Yeah, and Brad, we're also getting some reading, or a reading here on consumer confidence for the month of October. That handedly beating expectations, coming in at the index at 108.7. The estimate was for just below that 100 level at 99.5. So again, some improvement there. We've talked about the resilient consumer, a theme that we've really heard from many of the companies reporting, although very important to couch that with. It's very much a mixed bag, it seems like at this point, just in terms of inflation, how big of a headwind that is, how that is factoring in to spending plans and just the overall health and confidence here of consumers. But again, we are getting this reading coming in better than expected. And you would think that that would point, obviously, to a positive sign here for the U.S. economy going forward.
Just taking a brief look at some of the sectors here within the JOLT survey, the number of job openings actually decreased in healthcare and social assistance. That is synonymous with what we've heard in previous prints as well. We were even speaking to the CEO of Philips earlier this week, who was talking about the state of employment within healthcare and how that is a major focus there and where they're tapping into technology to offset where some of those positions have either been removed or people are not getting into the field quickly enough here. And so that is one of the major areas where we saw job openings decrease. State and local government, excluding education, was also down 79,000 positions, and then federal government down 28,000. But we did see job openings increase in finance and insurance. So that is your sector approach.
Interesting to point out. All right, Brad, great stuff. Thanks so much for breaking that for us. Our correspondent.
You got it. Anytime.
You can come back anytime. All right, well, that's the latest insight into the health of the labor market ahead of the October payrolls report this Friday. Here to break it all down, we want to bring in Greg Dacco. He's EY's chief economist. Greg, it's great to have you here. So let's just recap the numbers. We had job openings for the month of September. They fell to a 3-year low of 7.44 million. We're also getting the latest reading out on the consumer confidence coming in above expectations. The reading there for the index at 108.7. I'm curious, does this at all influence, or what is your biggest takeaway from maybe what this tells us about the health of the economy at this point?
Well, I think the JOLTS report is actually quite informative. It does show that there is much less tightness and continues to be less tightness over the past 3 years. We've seen job openings come back down to levels that are close to what they were before the pandemic. But importantly, in this report, we saw a slight rebound in the hiring rate, which shows you that essentially the floor is not falling under the labor market, but instead what we're seeing is a gentle cooling of labor demand and less labor supply absorption. Nothing catastrophic, but still this gentle softening of labor market trends. And in terms of confidence on the consumer front, consumers are not one homogeneous group. There are multiple elements, multiple tranches within consumers. We know that those at the lower end of the income spectrum are facing more difficulties when it comes to spending in a high price, high interest rate environment. But those at the higher end of the income spectrum are still spending relatively freely.
Greg, does this at all change, I guess, the calculus or your expectations that heading into Friday's print?
Well, I think generally speaking, we're going to have a very muddy report when it comes to the employment report. As you know, there were a couple of strikes that distorted the numbers, and there were also a couple of major hurricanes that likely distorted the payroll print. So we're anticipating a payroll print around 60 to 70,000 jobs being added over the month of October, but disruptions that are likely to be worth around 100,000. So maybe the underlying pace of the labor market right now is around 175,000 jobs per month, but that print on Friday will be extremely muddy. And I would caution anybody trying to over-interpret those numbers. You'll see markets trying to analyze and overanalyze the data as to what the Fed will do, but I would be very cautious, especially with this extremely muddy employment report.
Yeah, and Greg, this is something we were talking to our markets reporter Josh Schaefer about last hour, just in terms of the emphasis. We in the media obviously love to play up, and rightfully so, these big releases, but in terms of how closely the Fed tracks these single data prints, what is your interpretation of that, and just the likelihood that they will then maybe be more likely to just look beyond this noisy print?
I think we should be very careful with the data that we're going to get over the course of the next month because of those disruptions. When it comes to the data prints this week, we'll get a read on GDP growth in the third quarter, which was likely robust, around 3%. We'll get a read on PCE inflation, which is the Fed's favorite gauge of inflation, which likely moved closer to 2%, which is the Fed's inflation target. And then we'll get this muddied employment report. When it comes to what the Fed is likely to do, I think there are different groups within Fed policymakers. There are some that are seeing the latest data as an indication that perhaps they should slow down the pace of easing monetary policy. But I think the core of the Fed, which is still led by Powell's influence, is of the view that a gradual easing of monetary policy is optimal if you have a forward-looking perspective which captures disinflationary fundamentals and gently easing economic momentum. The goal is to neutralize the effect of monetary policy on the economy ahead of time, not be excessively reactive, as was the case over the prior 2 years.
So, Greg, we have the latest that's going on the labor front, obviously very important, front of mind for investors, for Fed, for economists who are trying to figure out what is next. I'm curious just to get your thoughts on inflation, though. Is inflation as under control as maybe the markets are pricing in or anticipate at this point?
Yeah, I think generally speaking, we've talked about this in the past, and I've highlighted that you should really focus on the underlying fundamentals when it comes to inflation. The process of disinflation is extremely bumpy because you have these monthly occurrences that disrupt economic activity and disrupt inflation readings. But if you look at the underlying fundamentals, which are 1, consumers are being more prudent with their outlays. 2, businesses have less pricing power. 3, wage growth is moderating. And 4, productivity growth is still quite strong, easing some of the inflationary pressures. Take all of those factors together, along with gently easing rent price inflation, then you have all the right ingredients to move us closer to 2%. Are there risks to the upside? Of course there are. The Middle East situation and rising oil prices are just one example, but transportation disruptions, supply chain disruptions are another example. So yes, risks are tilted to the upside, but the underlying domestic fundamentals are pointing towards further disinflation, which should allow the Fed to recalibrate monetary policy.
So, Greg, what do you think the Fed should do then next week? Cut by 25?
I think generally speaking, a gentle and prudent approach to monetary policy would be the optimal way forward in this highly uncertain environment. We haven't talked about the elections, but there's tremendous uncertainty as what the policy outlook could be post-election. Those risks make the case for a gradual and steady easing of monetary policy. You may recall that a few years ago, Powell had talked about navigating a dark room and feeling your way through this dark room. I think this is very much the time to adopt this prudent approach of gently easing monetary policy, and 25 basis points rate cut would be optimal, in my opinion.
All right, Greg Dacko, always great to get your insight. Thanks so much for joining us here this morning.
Thank you.
The U.S. dollar is extending gains for a third day on the back of today's economic data. However, many seen that the currency as a proxy for the Trump trade, with tariffs seen as a bullish signal for the greenback. Joining us now, we want to bring in Steve Dooley. He's head of market insights at Convera. Steve, it's great to have you here. So let's talk about where the dollar is headed, because the strength obviously is something that many investors, many traders have been closely tracking here over the last several weeks. How much is riding on the election outcome when we're trying to gauge what that future move is going to be?
Yeah, look, in terms of Q4, the election's going to be the most impactful event for the US dollar. We've seen that over the last 3 months as we saw post Joe Biden's resignation from the race. We saw the US dollar fall as the likelihood of a Trump presidency, according to polls, according to the betting markets, fell. And that really continued that theme up until the start of October. We saw the polls start to tighten. We saw betting probabilities improve in favor of Trump, and we saw the US dollar snap back really significantly, up more than 3% in October. So financial markets are telling us, in terms of FX markets, that a Trump win, the potential for tariffs, the potential for inflationary impact, and also the impact on those real trade-sensitive currencies like the Canadian dollar, like the Chinese yuan, is all building into the fact that for the moment, markets see a Trump win as more positive for the US dollar.
And see, something that stuck out to me in your notes that you sent over was that the first reaction usually doesn't stick when it comes to the FX market and ultimately what that means for the election. So how are you advising, or what is your advice then to investors? Is this a trade that maybe they should be staying on the sidelines for a couple of days? Is it a couple of hours? I guess how should they then be thinking about the timing?
Oh no! So when we say the first reaction sometimes doesn't stick. It can be a couple of months reaction until eventually that long-term move starts to play out. So historically, over the last 50 years or so, there's been a really clear, tight relationship between a change in the presidency and a change in the overall trend of the US dollar. And historically, it's been the fact that Democrat presidents have tended to be more supportive of the US dollar, and Republican presidents have tended to see the US dollar weaken. And that said, if we go back historically over the last couple of elections, 2016, the initial reaction was again that a Trump win would be positive for the US dollar. We saw that the greenback really gained for the first couple of months after the election. But throughout most of the Trump term, the US dollar was weaker, and that played out with that historical bias that tends to see Republican presidencies see the US dollar weaker. Again, after Biden's win in 2020, the US dollar was initially weaker. Again, that was the story about perhaps we'll see tariffs relaxed. That helped the Australian dollar, the Canadian dollar, the Chinese yuan to outperform, and the US dollar start to weaken. But with Biden's large spending programs, that move that ended up seeing inflation higher and interest rates higher, that saw the US dollar really outperform. It's up about 14% over the Biden presidency, and that's the third best presidential performance since 1970. So when we say the first reaction doesn't stick, it can be a couple of months. So traders will be looking to really take advantage in the short term of that current phase where a Trump win positive for the US dollar, a Harris win more positive for those trade-exposed currencies, and the US dollar likely to weaken.
All right, Steve Dooley, we have to leave it there. Thanks so much for taking the time to join us here this morning.
Thanks for having me on.
Sticking with the election, now 1 week away, Yahoo Finance's executive editor Brian Zazi asked Cisco CEO Chuck Robbins what Trump's proposed tariffs would mean for his business.
A lot of these tariffs would apply to components that we would be bringing into the United States, as an example, to actually complete manufacturing of a product in the United States. And so there are a lot of examples today where we continue to do manufacturing in the United States, and we're paying tariffs today on components that we're bringing out of China, which is counterintuitive to what the objectives of different administrations over the last 8 to 12 years have been, which is to create manufacturing jobs in the United States. And so I think we have to be thoughtful, and hopefully whatever administration is in will be thoughtful about how and be somewhat surgical about where they choose to deploy tariffs. But we're very much into creating pro-growth trade policies, and I think that's what's really important for this country.
You can catch Brian Zazi's full interview with Cisco Chairman and CEO Chuck Robbins. That's going to air later today on Market Domination. Tune in at 3 p.m. Eastern Time for the conversation. Coming up, Alphabet kicking off a string of Mag 7 earnings this week. What to expect next on Catalysts. Alphabet is the next Magnificent Seven company to report earnings out after the close today. I spoke to Mark Mahaney, Senior Managing Director and Head of Internet Research at Evercore ISI, about the top factors that he's looking for in the company's results. Here's what he had to say.
I think it starts with search and it probably ends with search. So can they maintain search revenue growth, kind of double digit, solid 12, 13, 14% search revenue growth year over year? Does the outlook continue for that? Second is YouTube. If there was one weakness in the June quarter, and like generals, investors always battle the last quarter, the softness last quarter had to do with YouTube, which came in a little light. So does that turn around or not? And if it doesn't, why hasn't it turned around? It's not like it's declining, but the growth did come in light. And so that would be the secondary issue. And then third, there is a broad expectation in the market that the cloud companies will be able to print accelerating revenue growth in the back half of this year because industry cloud demand is accelerating. So Google Cloud should show that. By the way, so should Microsoft Azure, and so should AWS.
I wonder what you think, Mark, about the AI goodness. It feels like Google has not had the first mover advantage on that. What do you expect to hear from Alphabet's earnings specifically on AI?
Well, they've been talking about how they're trying to infuse AI into all their products and services. I mean, I think you're seeing it in AI overviews or in Google Gemini. And then I think you're seeing it also from a marketer perspective. So not too many consumers see this, but in terms of the way that they're able to help marketers and advertisers better target, better manage ad campaigns, better drive attribution, and all of that should lead to a higher return on ad spend, which should lead to continued kind of robust ad revenue growth across the board. So I actually think Google's done a decent job with AI. They've been investing in it for, 7, 8 years or something like that. I think they got caught a little bit flat-footed by OpenAI, but my guess is that they have the ability to easily catch up to where OpenAI is.
All right, well, AI will certainly be front and center when Google reports, Alphabet reports after the bell tonight. We want to continue this earnings conversation because AI taking center stage also in AMD's results after the close. Here with what investors can expect is Yahoo Finance tech editor Dan Halley. And Dan, there is a lot riding on these earnings numbers that we'll be getting.
Yeah, this is kind of a almost preview of what we might expect from NVIDIA, AMD's biggest rival, or I should say biggest, I guess, bully almost in the AI space. So let's just go over the numbers real quick that we're expecting. For the quarter, we're expecting to see revenue of $6.7 billion. That would be up from $5.8 billion in the same quarter last year. Earnings per share of 92 cents. That's up from 70 cents. And obviously, the key metric that everybody's going to be looking at is AMD's data center business. Now, that's supposed to bring in $3.46 billion. That's up from $1.59 billion last year. And analysts say they're expecting $1.39 billion of that to just be from AI and GPU revenue. So not just not CPU, but that would be just the GPU side. The other thing that we have to take into account, though, is yes, the data center business is the one that's exciting, that everybody's amped up about, but the client side is still a huge part of this company, as it is with Intel. But the client business over here is expected to bring in $1.71 billion. That's versus $1.45 billion in the prior year quarter. I think the difference between Intel and AMD is that Intel's client service is still the breadwinner, whereas AMD, the data center, is now the breadwinner. And then one other thing that's worth pointing out here is that AMD's gaming segment is projected to drop revenue nearly $1 billion. So they're expecting to they're projecting $572 million to come in for the quarter for gaming. And that includes things like graphics processing units for desktops and laptops, as well as custom chips for the likes of Microsoft's Xbox and Sony's PlayStation. You know, there was the huge boom around the pandemic. Now we're starting to see sales kind of level out. And so that's impacting AMD. But you can expect those companies to start projecting or looking at purchasing new chips for the next round of consoles. We'll see when that comes in the future. But I think really this is going to provide us with a general sense of what we can expect with NVIDIA when it comes out at the end of November, which is it's just the most annoying thing.
I know, it's so delayed, and it has the largest buildup, and just the fact that obviously its influence and dominance on the market right now, I think it's frustrating for everyone to have to wait until then. But Dan, I guess I'm curious what you've made of the chip earnings that we've seen so far, because we certainly have seen almost this bifurcation just in terms of outperformance versus underperformance, where we are seeing some of that strength. In terms of what we hear from AMD, do you think it's going to be more similar just in terms of what we heard from TSMC, that strength, that all-out demand for AI, and ultimately what that tells us about further adoption going forward?
Yeah, I mean, I think that the data center business is going to do well. Obviously, I think that's kind of a given at this point, and it's based on what we've heard the hyperscalers say, right? It's what we've seen in the prior quarters that they've been spending on build out, right? Their CapEx has been huge. Part of that also has to do with, believe it or not, land, purchasing up land for data centers, so leases as well. And part of that is also the GPUs that they need to power these AI applications. So I think we're going to hear, obviously, from the data center business for AMD, it should do very well. I think one of the things just to keep in mind for people is that we've seen this explosive growth from these businesses, from these AI chip makers. And the immediate market reaction to NVIDIA last quarter was, well, it's not 10,000, obviously I'm joking, but 10,000%, right? It's 400% or whatever. And so the immediate investor reaction was, well, that's not great, but it's still incredible. So I think that's one thing to keep in mind when it comes to something like AMD and they're reporting a data center and their overall revenue is we're seeing these jumps that are so big that once they start to get large enough, the increases are going to be smaller. And so I think people may have a kind of knee-jerk reaction to that, but you have to look at the numbers overall and understand where they've been prior to what they are now.
All right, Hallie, great stuff. Thanks so much for breaking that down. Of course, we'll hear from AMD after the bell here today. Sticking with AI, Vinod Khosla, the founder of Khosla Ventures, spoke at TechCrunch Disrupt in San Francisco last night. Here's what he had to say about the future of AI.
But I think it's important to get the message of what AI affords us out. And I've taken a pretty strong positive view of what AI can do for us. And there's way too much of a dystopian vision from the effective altruism folks who are like, to me, kooks, entirely kooks. And it's important to counter that narrative, especially since the narrative of a sentient AI and what's called hard takeoff, killing all of humanity, is just would take away so much from all the people who stand to benefit from the advent of AI.
Right. So
I think it's important for me to get out there and to be talking about the benefits of AI.
Great. Well, so you did do this essay, you wrote this essay recently, a 10,000-word essay that was sort of exploring the dystopian and utopian versions of AI and its long-term ripple effects. I did think it was sort of funny. Business Insider had run it through ChatGPT to produce some output. Did you happen to see that? I was just wondering what you thought of it.
No, I did
not. Okay. Well, they said basically, if you will indulge me for a second, Khosla's description of life with AI sounds like a good one, with highlights that include enhanced human capabilities, better health care, a potential 3-day work week, a redefinition of human purpose focused on creativity and passion, and robust GDP growth that could make universal basic income more practical. Why are you so optimistic about an AI-infused world?
Well, I'm optimistic because what AI can do. Almost all expertise, it doesn't matter whether you're talking about primary care physicians, mental health therapists, oncologists, structural engineers, or accountants, all of it can be near free. Almost all human labor within some reasonable time frame will be near free because of robots, both bipedal and others. So when you live in that world, we'll see great abundance, great GDP growth. And there's some problems with that, but when I first wrote about it, I think it was 2016, I wrote a 5,000-word blog in Forbes that said AI will lead to great abundance. This is a couple of years before we invested in OpenAI. AI will lead to great abundance, great GDP growth, great productivity growth, and increasing income inequality. Mm-hmm. So that is a separate issue we should address. I'm very optimistic of what AI can do, and this was before any of the large breakthroughs in AI. And so when we got an opportunity in 2018 to commit to investing in OpenAI, it was an easy decision to make, though pretty vague decision because it was so obtuse what we were investing in and where it would go. So I'm very optimistic of what AI can do for humanity. I think fundamentally the need to work will go away. We will dramatically increase GDP growth from probably 2% to well over 5%. That will create enough abundance to take care of the people who are negatively impacted, which is my biggest concern.
It's my biggest concern as well. I was going to say, I think some people would say the need for work to go away, or the fact that it may go away, and your version of events is pretty dystopian, and they're scared.
And I do, and this is why I recently wrote a 25-page essay called AI Dystopia or Utopia. Mm. And as I was telling you backstage, I purposely addressed the dystopian view first, because I wanted to address each of those individually. There's half a dozen dystopian visions people have proposed will hurt us. And I address each one of them individually. We don't have enough time to cover that here today. But I do think there's sensible answers. And by and large, those will be societal choices we make. And they will be made country by country, and each country may make a different choice.
That was Vinod Khosla, the founder of Khosla Ventures at TechCrunch Disrupt. The Biden administration releasing its finalized rules to curb U.S. investment in advanced Chinese technology. The new rules are effective January 2nd, with the Treasury's new Office of Global Transactions overseeing it. The restrictions covering 3 sectors: semiconductors and microelectronics, quantum information technologies, and artificial intelligence. American companies are prohibited from investing in certain technologies within those industries and require the Treasury Department to be notified of other investments in less advanced technologies. The goal of these restrictions, according to a statement from the Treasury Department, is to limit not just capital, but, quote, intangible benefits like managerial assistance and access to investment and talent networks that could help countries like China, quote, develop their military intelligence and cyber capabilities. The new rules do have exemptions allowing for investment in publicly traded securities, as well as certain limited partner investments. Coming up, U.S. Treasury yields are reaching a 3-month high. That was for the 10-year, just ahead of the election. We're diving into all the recent news impacting the bond market next. The 10-year Treasury yield hitting its highest level in 3 months today as traders look ahead to Friday's jobs print, next week's presidential election, and the upcoming Fed rate cut decision. Here to discuss the implications for the bond market, we want to bring Leland Clemens, founder of fixed income ETF specialist Bond Blocks. Leland, it's great to have you here. So let's talk about this move higher, this relentless move higher. It seems like we've seen in yields. We have a sell-off going on in the bond market. So here we are with yields at that 4.3 level. What should investors, or what do investors need to know? Are we likely going to push up against that 4.5 level?
Yeah, I think investors need to remember that rates may have backed up because the economy is strong. Corporate balance sheets are strong. Corporate earnings are strong. When you look at what's happened in the S&P 500 earnings after Q3, I think we continue to think investors need to lean in to this opportunity, look at corporate bonds as an opportunity for further investment rather than sort of playing into the short-termism of what's happening with rates this week, next week.
When we talk about maybe mitigating the risk, though, in the short term, what is the number one thing that investors need to keep in mind?
Yeah, again, I think investors need to, remember that fixed income is there as a ballast. That monthly income or quarterly income that comes from fixed income, particularly ETFs, can be a real ballast in the face of uncertainty. And I think staying the course, remembering that the economy is strong, is just really important amidst what is inherently going to be over the next few weeks a lot of narrative that can be distracting.
Leland, how much of that, when we talk about the narrative that could be distracting, and we're seeing obviously much of this already being priced in, is it fully priced into the bond market, do you think, at this point?
Yeah, I think what's priced in, again, is a strong economy. We've even looked at corporate balance sheets, interest coverage for U.S. corporations. We feel like things like high yield still offer really attractive yields. Over the last 9-10 months, things like triple Cs have returned somewhere 12%. So investors really have an opportunity to lean into these yields and take advantage of really attractive entry points.
Leland, when we talk about the fight against inflation, a lot of things, I know you're taking a look at the longer term, but we've got to talk about the short term and that volatility. Sure. I guess, how much is that, when we take a look at what the market is pricing in or what the market is betting in terms of the fight against inflation, the fact of how much progress the Fed has made, has that been a little bit overextended in the bond market? Yeah, absolutely. We think traders may have overextended themselves for sure. Perhaps betting on what they want to happen than rather following what is. The Fed's been very clear, right? They're going to take a data-driven approach, looking at things like earnings, things like inflation, things like employment, and candidly, the data has come back more positive than I think a lot of traders may have bet. And so investors can look at that again, short term, and certainly, as I said, long term, as an opportunity to capture yield. You're saying that the biggest driver is ultimately going to be and has been the overall health of the U.S. economy and the resilience that we've seen there. As we look ahead to the next several months and you take a look at the Fed announcements that we're going to get, the election, some of the uncertainty surrounding that, and then, of course, these one-off econ data prints and even earnings, what is the one biggest driver you think for the bond market? I think the biggest driver, we think the biggest driver for the bond market will, again, continue to be economic data around earnings, around corporate balance sheets, and really that fundamental data that the Fed is looking for. Sure that they'll continue to look at inflation as well, but that's generally been held in check reasonably well. So again, we will continue to look, and we think investors should continue to look at the strength of U.S. corporations. All right, Leland Clemens, thanks so much for taking the time to join us. You bet. Thank you. Coming up next, we'll be taking a look at some of today's biggest market moves of the day and give you the news behind some of those moves that we're seeing. That's coming up next on Catalysts. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session. That's what the Yahoo Finance's trending tickers page. Here to break it all down, today's moves, Josh Schaefer is back for day 2. We'll see whether or not this is a pattern going forward. All right, first up, let's take a look at SoFi, because SoFi Technologies is a trending stock here at Yahoo Finance today. Not for good reason, though. The stock is off just about 9%. They did, though, beat third quarter expectations boosted by financial services and its tech platform segments. CEO Anthony Noto calling it, quote, the strongest quarter in our history. The company also raising its 2024 forecast and adjusted net revenue and earnings per share. He also went on to say, and I wrote this in my notes if I can find it here, that it was actually the best environment that SoFi has ever operated in. And what stuck out to me was just where things stand versus maybe what he is seeing, the opportunity specifically within SoFi. We have seen certainly a lot of excitement around the fact that they have been expanding their business, but here we are with rates still very high, especially compared to what we've seen over the last decade plus, and has been a headwind. And I think that's also being reflected a little bit in SoFi's results here today.
Sometimes too, Shauna, just zoom out and look at the stock over 3 months, right?
Well.
There's our chart right there. It's up over 40% in between earnings. And sometimes, yes, they're beating estimates, right? But the bar, just given the stock price rise, can be hard to meet in some of these reports, right? And I think that's definitely part of the story here. You just ran through the numbers. Basically all beat, all pretty solid. I thought it was interesting too, they pointed out they're obviously big in the high yield savings kind of space. They're saying they're still seeing flows there, right? That's something we've talked about a lot. As rates come lower, is money still going to flow into that savings business? They're still seeing that for now. But I think there's probably 2 key questions for investors moving forward with SoFi, which would be A, what does lower rates mean for the company, and where are rates actually going to fall over the next year? B, student loans are still a big part of their business, right? And that's a big question going into next week in the election and what is going to happen with student loans in general in this country over perhaps the next decade, right? Are certain plans going to come into place that would perhaps help people pay student loans in other ways that wouldn't be business with SoFi? That's a long-term question, I think, that's still yet to be seen for them. But I think overall, today's stock move, I'm looking at the shares over the last 3 months and saying, okay, maybe just a little bit of a pullback after ripping pretty hard over.
Yeah, and the outlook just simply not being enough there to satisfy what the street was looking for, just in terms of expectations, given that massive run up. But that's a great point that you make about the student loan business. Looking ahead to the election next week, obviously a lot of uncertainty. SoFi has worked over the last several quarters tirelessly to really diversify beyond the student loan business, but obviously just in terms of how important that is to the credit.
It's a good part of their business too, right? So for that to continue is definitely important. It's something that they do well. So for that to be a continued catalyst for them over the next couple of years, I think remains a question, just where we go with student loans in the U.S.
That's a good question about where we go on a lot of things beyond just student loans. All right, let's take a look at PayPal. PayPal's reporting better than expected third quarter earnings, but revenue did fall a bit short. The digital payments company expecting low single-digit revenue growth for the fourth quarter. Once again, you're looking at pressure on this stock. They didn't meet expectations. We're seeing that reflected in the move lower here, off just about 6%. Obviously, this gives us a little bit of a better idea, or a good idea, just about the health of the consumer, what we are seeing consumers willing to spend on, whether or not we are seeing a bit of a pullback there. But fourth quarter expectations very much largely in line with the expectations that we did see. Nothing really standing out too, I guess, different than what the expectations were in this report.
No, I mean, again, I'm going to make the same comment because I think it's important to seriously keep in mind with this. Look at PayPal over 3 months, right? Also a stock that had rallied into reports. A lot of analysts were talking in their notes going into the report. Maybe the good news is a little bit priced in when it comes to PayPal. And then looking at that revenue miss, this was something that our friends Liz Ann Saunders and Kevin Gordon were writing about over at Charles Schwab. The overall macro environment right now, investors seem to want top line sales growth, perhaps maybe even more than earnings growth, right? Because we've been talking about earnings starting to rebound for a lot of companies over the last couple quarters, but a lot of that has been from cutting costs, from getting better margins through cutting costs. At what point do your sales rebound and is top line improving is sort of a looming question over a lot of stocks in the market. So it's interesting to see that on a micro level when it comes to PayPal. One other thing I wanted to highlight, Shauna, because I thought this was interesting, both these companies, both PayPal and SoFi, very exposed to interest rates, right? What are they saying about rates on the call PayPal and rates coming lower. So PayPal was talking about it actually being a drag on their transaction margin dollar growth. So their executives pointing out that essentially for every 25 basis points of cuts, that's about $40 million of transaction margin that comes off the table. Spin that forward to 2025 projections, you're talking about 1% to 2% less of transaction margin growth just simply because of those interest rate cuts. So again, the uncertainty of where rates are a year from now playing a role a little bit here in that story.
Yeah, and the significance of that, the transaction margin dollar growth, actually Dan Dolev over at Mizuho, friend of the show, called it the most important metric when it comes to when you're trying to gauge where.
And so if you potentially have a drag on that, and then there's still the question of, okay, right now we're looking at 5 cuts next year. What if it becomes 7 because the economy gets weaker, right? And then you're talking about more of a drag, or perhaps that narrative shifts and it flips a little bit. But I think you're starting to see signs of the uncertain macro, which you always see in these earnings calls, but definitely playing out a little bit in terms of companies that are specifically exposed to interest rates.
Yeah, certainly. And it's a theme we're going to continue to watch throughout this earnings season. Let's get to crypto. Crypto stocks rallying as Bitcoin tops 71,000, just shy, I believe, of $72,000. The first time it topped $71,000 since June. Optimism building ahead of the presidential election next week. Coinbase, MicroStrategy, both slated to report earnings tomorrow. Those will be 2 names to watch. Of course, we could see some expected volatility there. But again, Bitcoin just continuing this relentless move higher. We're seeing the Trump trade priced in. We've seen Bitcoin be a beneficiary there of that. So we'll see whether or not this move higher holds.
MicroStrategy is an interesting one, right? Stock's up over 300% now year to date. Over the last 3 months, it's up over 40%. Our friend Jared Blickery, one of our markets reporters, has highlighted time after time, MicroStrategy usually leads Bitcoin. What exactly the correlation is there, I'm not entirely sure. But when you look at charts, it's normally been MicroStrategy rallies and then suddenly Bitcoin follows kind of within that.
You're talking about the leadership of MicroStrategy versus.
So MicroStrategy will rise, and then in the months following, you start to see Bitcoin rise. So we've seen that MicroStrategy rise. Now do you get the Bitcoin follow through? The other thing with crypto that I always think about is just what it says about sentiment, right? Because let's be honest, a lot of this is pretty speculative, right? And I was talking the other day with Carson Group, Ryan Dietrich, and his colleague Sonu, and we were talking about how we haven't seen a lot of that euphoric sentiment right now. Market near record highs, but we're not talking about GameStop. We hadn't really been talking about Bitcoin until maybe this week, but you're starting to see that spread a little bit, and I'm curious kind of how far that carries. Again, post-election, do you start to see this market get a little bit more frothy? Bitcoin is always a piece of that to me.
How worrisome to be about what's happening next, I guess, too. All right, Josh, great stuff. Thanks so much. Let's take a look at shares of Tesla this morning. Elon Musk taking the stage at Saudi Arabia's Future Investment Initiative Conference in Riyadh. Now, the Tesla CEO making some comments about the future of autonomous vehicles while at the event. Musk said that he expects unsupervised self-driving in the U.S. by next year, and says that the Cybercab is expected to reach a volume production in 2026. Musk also saying that he plans to launch Starships to Mars in 2 years and also expects more robots than people by 2040. The autonomous comments coming after a splashy reveal of a self-driving car earlier this month, but the robotaxi event failing to live up to those high expectations, putting more pressure on the company's bread and butter business of selling EVs. So again, important story to watch. Once again, lofty expectations, promises. We'll see how this all plays out. Coming up, cybersecurity taking center stage ahead of the election next week. CEO of Checkpoint joining us next on Catalysts. Checkpoint Software dropping more than 14% after reporting third quarter results today. The cybersecurity provider's revenue rising 7% from a year ago, boosted by strong security subscriptions growth. But margins taking a hit as expenses rose. Joining me now is Checkpoint CEO Gil Schwid. Gil, let's start with the market's reaction. And I know you're probably going to tell me you don't pay too much attention to what the market gauges just off the heels of this print. But I'm curious just what you think the market is missing in this report, given the fact that we are down nearly 15%.
First, we do pay attention to the market, and I guess the market was expecting much more from us because we hit all our financial goals and all our projections, and I think we had pretty good results for the quarter, but our stock has run up recently quite a lot, and I guess the market was expecting even more.
Yeah, and similar to what we're seeing and to some of the other names that are reporting this morning that aren't handedly or exceeding expectations maybe as much as the street had hoped, given the run-up that we have seen in some of these stocks. Gil, let's talk about what you are seeing for the quarter, what you saw for the quarter. A record spike in cyber attacks. Give us an idea just of how big of a jump you are seeing and what that signals in terms of what's ahead.
We definitely see that there is way more cyber attacks, and not only more cyber attacks, they're getting more and more sophisticated. Over the past year, the number of cyber attacks has increased by 75% globally, 56% in the US. And again, it's not just the numbers, it's really the sophistication of the attack, so it's pretty scary.
And how difficult does it make it to detect? Does it make it to alert these attacks, given the degree of difficulty, challenging, how complicated some of these attacks are getting?
First, the challenge is not to detect. Detect is not enough. The challenge is to prevent or stop the attacks from getting into the organization. It is not easy. The new generation of attacks, we call it the fifth generation of cyber attacks, are very hard to detect. They usually go into an organization, move inside, take over the organization, and then create their damage, whether it's ransomware or stealing information, which in many cases is even unknown. We don't even see it. So it's pretty hard to stop these attacks.
So we saw a 75% increase year over year in terms of the record spike in cyber attacks. In terms of your projections of what that number could look like a year from now, are we talking about another ballooning figure?
Well, it's been growing quite significantly over the past few years. I don't know if I can predict it will grow or not. What I definitely know is that we need to stand and stop that. We need to prevent these attacks. It requires a lot of thinking. It requires more coordinated approach by security vendors, both within the same vendor and maybe sometimes even between different security vendors. And it also requires the customers to deploy the latest security defense technologies.
The role of AI, Gil, how big a role is that playing in your process right now? And is it almost a double-edged sword when it comes to the fact that it could help, but it's also making some of these attacks very sophisticated and I would think harder to detect?
You are absolutely right. AI is a double-edged sword. At one end, it makes it far easier for anyone to be an attacker. AI can write code, and AI can write phishing emails. AI can do a lot of things that before required more expertise. On the same time, for us as people who defend and build the future of cybersecurity, AI is an amazing tool. If security analysts require to analyze a lot of data and find different patterns, AI can do it in a much better way. AI can program new defense methods. So, I mean, AI can definitely be a great help for us who develop and operate security systems.
And Gil, there's been some reporting and some discussions really from other the executive leaders within your industry talking about that skills gap that maybe we are seeing in cybersecurity as the industry grows just so tremendously here over the last couple of years. Is AI bridging that gap? Or talk to us, I guess, about the fact that maybe that could help at least as we try to get a more skilled workforce?
Absolutely. There's a lot of talk about skill shortage. There's been talking about millions of employees that are missing in cyber, and many of them can be replaced or augmented by AI agent, which will exactly do that job. Analyze different records, find patterns of attacks, act, by the way, work 24/7. We as human beings, we can't work 24/7. The AI agent can. So I think AI can help bridge the gap and make the human do more human-like work of defining the policies, ensuring that the system works, dealing with tough situation rather than the day-to-day work of either configuring systems or going through a lot of attack data.
Gil, when it comes to the election, just 1 week out from today here in the U.S., the election cyber risk, I know it's something that you're tracking. What is your data showing you there?
We're definitely seeing more involvement and more attacks on the election situation. There's been things that we're less involved, like fake information and so on, that being generated by AI, but there's been a lot of other attacks. I mean, we've heard reports about mobile phone of the leading candidates for US presidents being hacked. It's scary. I mean, absolutely. I mean, the fact that hackers can get all the way down to the heart of our systems is something that we should elevate the level of security we use. By the way, mobile security is a good example because almost no one is using mobile security software in the world. It exists. People don't use it.
That's a great point. Gil Schwed, we hope to have you back again soon. Congratulations on the quarter. CEO of Checkpoint. Thanks so much, Gil.
Thank you very much. Appreciate it.
Let's get a quick check of the major averages just about 90 minutes into the trading session, and we are looking at gains, slight gains across the board. You got the Dow just above the flat line. You've got the S&P up about 0.1%. The NASDAQ gaining some momentum, now up about 0.3%. The move higher in tech coming ahead of very critical earnings reports out after the bell tonight. We've got Alphabet and AMD on tap. Keep right here on Yahoo Finance. Coming up, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Stay tuned.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains. We're off for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, the Magnificent Seven, they're taking center stage once again. Alphabet reporting its third quarter results after the close today. A portfolio manager will break down how investors should navigate this busy week of earnings. And rising home prices and mortgage rates are keeping some buyers on the sidelines. We'll dive into when the right time could be for you to dive into the housing market. Plus, Medicare recipients will no longer have to pay more than $2,000 out of pocket for the medication in 2025, but there may be a hidden downside to this news. An expert will break down everything that you need to know about Medicare Part D later on in the hour. All that and much more coming up. But first, let's take a look at some of the market action. We are 90 minutes into the start of today's trading session, and we're taking a look at stocks right now, mixed. This is after a deluge of earnings this morning, plus there's even more to come after the close. With all eyes on the Magnificent Seven member Alphabet, oh yeah, that report coming. How should investors be positioning earnings and their portfolio as the earnings season heats up? Joining me now on set, we've got Nick Tell. He is the co-founder and CEO of Armory Group. Nick, great to have you here with us. So first and foremost, you think through this earnings season and the weight the Magnificent Seven is going to be carrying here. Could this turn the tide at least, or at least kind of better some of the performances, especially as we've seen some of the earnings growth lag expectations just by a little bit to this point?
Well, I think, the fact is that the consumer these days right now is on a value hunt. And so it's really those companies that can provide that value, we think, are the ones that are going to do best in this type of market environment. And so to the extent that they provide it and provide that value, I think that they should be able to outperform from an earnings standpoint. But to the extent they don't, I think there's going to be some disappointments.
And so within that Magnificent Seven here, are you expecting, of course, as we're tracking some of those bellwethers who can really kind of make or break the earnings season, what are you anticipating from them?
Well, I think those have been managing expectations pretty well. And so as a result, I think that to the extent that there's disappointments, it's already embedded in the numbers. And so my guess is that we're going to see some outperformance as a result.
How much of a long tail do you believe that AI as a theme that's certainly played out for these companies continues to have this far?
Well, it's like I think you've pulled a lot of demand forward because people anticipated and hoped to be able to catch up to it. But I think there's going to be some slowdown because I think at some point it's just too much has already been invested, and now we're going to have to slow down for a bit in order to catch up with the actual demand as it appears.
And from that demand component as well, I mean, the demand is going to play out in two vastly different ways.
Exactly.
It's the end consumer demand, but it's also that B2B demand as well.
Right.
And trying to front run.
Well, that's the problem is the B2B is front running the end. It's just a question of when's the consumer going to catch up, right? Because there's a lot of investment dollars that have been put in on the B2B side. And the consumer is, still cautious and trying to figure out sort of what exactly they're going to use it for and whether it's something good or something bad.
Yeah, exactly. All right, I know I'm in that camp as well here. Yeah. Let's turn to the bond market for a hot second. After the bond market saw its worst sell-off in 6 months, yields resuming their climb here higher this week. How should investors be playing the bond market right now?
Yeah, I mean, the duration trade really got ahead of itself with the expectation that the Fed was going to cut a lot quicker than ultimately I think they're going to. And so I think what you see is that we've been advising clients to shift back to floating rate. For the first 6 months of this year, we were actually shifting out of floating rate into sort of longer term bonds, but now shifting back into floating rate loans and actually focusing on credit because we do think that the economy is going to stay stable to slightly growing. And so as a result, take advantage of where the best yields are, and that's really in the floating rate environment, whether it's in loans, whether it's in private credit, even AAA CLO type financings, there's real opportunities for yield. And the best thing about yield is it's dollars. You get them up front. And so you're not dealing with it softens the volatility of the market.
It's interesting when we think about the bond market and we think about fixed income as a play specifically, how much of that do you think is still right to be concentrated on U.S. treasuries versus currencies elsewhere around the world?
Well, I'm more of a U.S. manager, and so not the expertise throughout but I think but it is all relative value play at the end of the day. And what we're seeing is that, interesting enough, the election is going to have some volatility, I believe. And so to the extent that you are playing treasuries, you may think about shifting to other currencies or other bonds for the time being, because I think there's going to be some impact in the U.S. Treasury market that comes as a result of the election.
You mentioned the election 1 week away, of course. Should investors take the potential outcome into consideration when really positioning their portfolios?
Well, you don't like to have sort of short-term events that lead to, long-term volatility, because ultimately you can miss trades because no one knows exactly how it's going to play. I do think that you have to be cautious about sort of where the outcome is going to be, and there might be some short-term volatility that comes with it. But if you're a long-term investor, you just hold through it, as opposed to trade around it.
Yeah.
If you're a trader, then you'll trade around it.
There you go.
Yeah.
Nick Tell, who is the Armory Group co-founder and CEO, joining us here in studio. Thanks so much for taking the time.
No, it's a pleasure. Always. Thank you, Brad.
Well, today is the first very busy day of a super busy week of earnings, with 5 of the most valuable U.S. companies in the S&P 500 set to report. On the whole, to this point, earnings growth has come in shy of expectations. UBS had expected 5 to 7% EPS growth for the S&P 500, but of reports made public thus far, the real number is tracking closer to 3 to 5% growth. A few household names may help lift investor spirits, and you may have contributed to those results from your own everyday use. Apps, spends, and eats are the buckets that we're going to create for you here. And these companies give insight into the health of the economy. And so for the apps, we have Apple, of course, the highway for apps. And then you have also Meta and Uber. Now, Meta is the first of the group to report results out tomorrow, and then investors going to be eyeing how much they're planning to spend on artificial intelligence. Meanwhile, Apple's earnings are out Thursday, and that could give us some insight into spending on consumer technology, especially after the company began marketing its new operating system, artificial intelligence features. And of course, you got Uber. That's also out Thursday, and it's all about the discretionary spending for mobility. How often are consumers tapping that Uber app to catch a ride on the town in the last few months? Now for spends and that bucket that we created for you, this is where you're going to be keeping close tabs on Visa, MasterCard, and PayPal. This is going to look at the financial health of consumers now, not just whether they're willing to spend, but whether they're spending more than they can afford, measured by debt levels and perhaps even delinquencies. And finally, let's go to the eats here. AB InBev, Starbucks, and Chipotle. Food prices have been a sore subject for some consumers over the last few quarters, with sales falling at companies like Starbucks. Companies are working to offer people the best bang for their buck and give them value and bring them back through their doors, while also juggling elevated labor expenses. And of course, those aren't the only names to watch, but there are a few that are well known by your household to get you set up for the busy week ahead. Coming up on the other side of this short break, high mortgage rates are still keeping home buyers on the sidelines. We'll have more on what it means for the real estate market. Plus, big changes coming to Medicare drug coverage in 2025. We've got the tips on how to find the best plan for you. That's all coming up next on Wealth. Home prices hitting a new record high, but showing the slowest growth in more than a year. This is according to the S&P CoreLogic Case-Shiller Home Price Index for August. Yahoo Finance's Danny Romero joins us now with more exactly what this means for the housing market. Danny.
So home prices remain stubborn, but if we look at home price growth, that is honestly easing. On an annual basis, the S&P Case-Shiller National Home Price Index rose 4.2%, and that is down from 4.8% gain seen in July. Remember, this is a lagging indicator because it takes about 2 months to collect all of this data. So the reason behind home price growth really slowing down is due to the sluggish demand and more of that inventory, active inventory that has been added to the market. Remember, in August, mortgage rates were moving lower. They were hovering around that 6%. But a lot of first-time home buyers are really holding off and remaining on the sidelines. I spoke with a couple buyers over the last few weeks, and they say that they're waiting for rates to come down even more so, while others are really saying that home prices are just way too high. So affordability just remains an issue across the board for many buyers. And recently, mortgage rates have gone up. They're hovering around that 6.4%, 6.5%, according to Freddie Mac. And it's important to note that mortgage rates are more than 1% lower than they were this time last year when they were hovering around that 8%. So bottom line, it's really unlikely that we will see rates come down even further as there's this market expectation of less aggressive Fed rate cuts. Brad.
All right. Danny, we're going to be watching this extremely closely here, and the election could have some impact as well in terms of some of those buyers coming off of the sidelines. We will see what type of impact.
I haven't heard that commentary, though, yet.
It is.
We hear it from experts, but I haven't really heard it from an actual buyer just yet.
Potential buyers, It showed up in the Redfin survey data. So maybe we just need to find those people that are getting surveyed. That's what
I'm curious because I've talked to buyers and I'm not hearing that from them specifically.
Interesting. All right, Danny Romero, thanks so much. Well, Medicare's open enrollment period is here, and there are big changes in store for its drug plans. Here to tell us what you need to know, we've got personal finance expert and author of The Savage Truth on Money, Terry Savage. Welcome into the show here and into the conversation, Terry. So first and foremost here, let's just talk about some of these changes here. And the headline one that really caught our attention is that you'll no longer have to pay more than $2,000 out of pocket for your meds for 2025. But there's also perhaps some fine print to that as well.
Yeah, it sounds great, doesn't it, that headline? But there's a lot of hidden complexity here. Let me say one thing, first of all. I know Yahoo Finance listeners and watchers are a very sophisticated audience and probably a little bit younger. And some of you are tempted to say, I think I'll go get a cup of coffee now. This doesn't apply to me. Please listen, because this applies to your parents and your grandparents. And there are such huge changes that they won't understand if you don't help them, that it could be very costly for them next year in 2025 if they don't do something right now. And then they won't be able to give Christmas gifts to your children or their grandchildren. So this is really critical. Look, that big headline, $2,000 maximum, hides a lot of changes. And anyone who has Medicare drug coverage, whether you have that Part D standalone plan that goes along with your supplement, or whether you say, well, I don't have to worry, my drugs are covered by my Advantage supplement, you must check into what your drug coverage will be next year, because the drug companies aren't dumb. They've eliminated some drugs, only chosen generics, moved some into tiers that have costly copays. So you must do the search for how your drugs are covered. I have a big article up at terrysavage.com. I sell nothing, but the fact is you need to compare, and I have links. You want to compare at medicare.gov because it's very simple to create your own My Medicare account there. You put in your prescriptions. Immediately, they'll show you what drugs you were taking last year. You can say, well, this year I'm adding this and this, and you can click and compare 3 plans. Many people will find they're paying more. Some people, and this happened to me, found a plan that charges $0. I went $0.
Yeah.
I have 2 little generic drugs, nothing. And then some people are finding their drugs aren't covered at all.
Okay, so what do you need to do if you find that a drug that you've been prescribed is no longer covered as part of your plan?
Okay, so this is why you do the critical search. And even if it is covered, so let's start with this. Some people will find literally a well-care plan that has zero cost because some generic drugs have no deductible for the year. It's astounding, but go compare. Some people will find, gosh, my current drug plan is going to raise the monthly premium or it's going to raise the copays. I better compare because the drug companies want to get everybody up to at least paying that $2,000. So you'll have to search for less expensive. Now, if you're among those people, you know, Medicare doesn't cover some drugs right now. I mean, Wegovy and Ozempic, those aren't covered in bankrupt Medicare for sure. So what they're doing now is substituting generics. Some people can't take generics if the ingredient is the same, but the compounding formula could be different and cause allergies. This is when you're playing three-dimensional chess if you have expensive drugs in your plan. There's a great place to go for help if you can't compare at Medicare.gov. The state health insurance programs, SHIP Help, SHIP help.org, will connect you to your state's volunteer but very knowledgeable advisors who can tell you what you should do. You may be able to get one of your most expensive drugs directly from the manufacturer. They have senior health programs. If you take that off your formulary, you might find a drug plan that's far less expensive. So, and they also have a new way to pay this year. If you get your $2,000 limit on your most expensive drug in the first month, you can spread out those payments over 12 months. I am telling you, this is not your grandma's Part D Medicare. This requires some very sophisticated help. There are very next to no commissions in these plans. So it's very hard to find an advisor who will help you. The Advantage plans, of course, everybody's calling you.
Right.
They're going to say, well, see how expensive your Part D is? Come to Advantage. But they too have changed their formularies. So you have to compare. You may want to change your Advantage plan for the one that gives you the most coverage for your drugs.
Certainly.
This is complex.
Yeah. Terry, there's so much for everyone to look into and make sure that they're comparison shopping the right way for that Medicare plan. Terry Savage, personal finance expert and author of The Savage Truth on Money. Terry, thanks so much for taking the time.
Help your grandma. She needs it now.
I'll do, certainly. Coming up, everyone, we're breaking down how you should prepare for a money emergency with a financial first aid kit. That's right after the break. You probably have a first aid kit in case of accidental injuries, but do you have a financial first aid kit? To break down everything you need to know, we have Winnie Sun Group Wealth Partners Managing Director here. Winnie, good to have you back on the program here with us. All right, so walk us through the first aid kit, the financial first aid kit checklist, and everything that is analogous to something as simple as the Band-Aids in there, all the way out to perhaps some gauze pads. We're getting too literal, but just take us through that checklist.
Absolutely, Brad. Thanks so much for having me. Financial first aid kit is literally that. So think about the things that you might need in case of a natural disaster or unexpected medical emergency. We're talking about all the financial statements that you have. Think about like after you file your taxes, what forms and documents did you need? Those go into your financial first aid kit, as well as things such as a living trust or a will, or the names and email lists and the contact information of your financial advisors, your attorney, your credit card statements and the companies that they're with and the contact information there. You're talking about all that in one safe location that's quickly accessible to you. And I'll add, this is an important one too, because a lot of times we forget, if case of emergency, you want to make sure that this file is not only with you, but also you have an encrypted file on the cloud if possible. And then the other thing I would recommend is actually keeping a safe encrypted copy with someone that you trust outside of your state.
It's interesting, Winnie, and a great checklist layout there. I wonder, even as you're mentioning the encryption and needing to make sure that you're backed up to the cloud, for instance, how much of the checklist and how much of that financial first aid kit is tangible or is something that is physical copies and assets versus what needs to be digitized?
So, Brad, great question. I personally prefer to have everything in digital format because I think that gives you easier access, right? In case you're traveling or in case of, like here in California, in case of an earthquake or a wildfire and you're not at your home, then you have access to this data. And a lot of professionals, actually, like I'm a financial advisor, we have access to encrypted drives that are, that potentially could help our clients, and your attorney or CPA might have this as well. But yeah, in terms of physical, you might want to have maybe, a little bit of cash on hand, maybe a few $100s just in case of emergency so you can grab from it quickly. But aside from that, most everything can be digital.
It's interesting, especially in times of emergency, you always have that person that's listed, call this person if such and such happens. So how do you kind of go about putting together your call list, if you will, of who needs to be contacted first when you are thinking of this financial first aid kit?
Right, Brad. This was actually inspired because my dad had a medical emergency a few years back, and literally it was just scrambling, trying to figure out all the important documents, right? And so you want to think about in that nature, if something were to happen, and if I'm the person who is the organizer or person who takes care of the finances at home, what are the things that my family would need if I wasn't able to help guide them through this process? So one of the easiest ways to do that is to do this, right now is actually a great time. You just finished filing your taxes not that long ago. You can put everything into a folder, and then you figure out everything else. When you pay your bills, who do you pay? Where do you bank? All those documents should go into one place, and then take a moment to scan all that information. The other thing that I think is really important, especially for us parents out there, is consider including a letter to your loved ones. This not only gives them directions on how to handle who to contact, but there are certain things that you may have wanted them to know in case you're not there. And this is something that's a challenge for me because it's hard to get through that process, but recognize that if you don't do this, you don't want to have any regrets of not doing it in the future.
That's a really good and sobering point, but again, it's part of the preparedness as well. In that instance, what do you do with your passwords? Say you need to make sure someone else has access in the event that you aren't able to. How do you make sure that that access is still passed on as well?
So that's a great question. And a lot of password programs out there will have ways where you can actually assign a person or a safe person who will be able to have access. Like, for example, I use LastPass to collect all my passwords, right? And so you want to figure out what that process is ahead of time and find someone in your life who is somewhat technically savvy, that in case something happens, that your family knows to go to that person. In my case, my husband's my sister's tech savvy. So you want to find someone like that. And I can't emphasize that enough, is also to find someone who's out of state. It doesn't even have to be just out of state, it could be out of the country, but someone who's not in your geographical area, just in case of a natural disaster, then that person can help you out, and that they might be able to have internet access more quickly than someone that's in your neighborhood.
Winnie, great to have you back on the program with us. Some very valuable tips here. Winnie Sun, Sun Group Wealth Partners Managing Director. Appreciate it.
Thank you so much, Brad.
Certainly. We've got much more on wealth after the break. Stay tuned. You're watching Yahoo Finance.
Welcome to Stocks in Translation, our essential conversation cutting through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need for your portfolio. And today I'm joined by my sidekick, Sydney Freed, and Ryan Dietrich, making a special trip to New York, I think, hailing from Ohio. The Sultan of Seasonality, Bull Boss Ryan Dietrich is here from the Carson Group, Chief Market Strategist there. And welcome, guys. Today we're going to be talking about, guess what, the global risk roller coaster that we all seem to be riding on. And our phrase of the day is seasonality, of course, perfect for you, Ryan. And this episode brought to you by the number 86. That is the percent time the Russell 2000 index is positive 1 year following a 5-day 10% thrust, the likes of which we just saw. And we'll get into all those wonky details in a second. But Sid, Ryan, let me get, Ryan, your thoughts on the big picture market. We've had this terrible upset in the risk markets with the Japanese yen going nuts. What do you make of this?
Yeah, first off, thanks for having me, guys.
Yes.
This is going to be fun. I'm looking forward to this. Flew in this morning, and I'm here nice and smooth. It's raining in your city, though. It kind of messes things up.
No, you get a 74-degree day.
It's true.
Oh,
it's not hot.
That's actually a celebrate.
I was here 2 months ago. I was melting. But nonetheless, you think about this year. I mean, it's an election year, yes. We had the best start to any election year since 1976, middle of the year. And then here comes August. We get into the seasonality part of it. August sometimes gets these rare events. We've only, going to air quotes here, only had about 8.5%, mild correction so far. Now, most years see more than 5% pullbacks a year. Mm-hmm. You see a 10% on average. I mean, our take, we get into the details of this, we still do not see a recession. We still think it's a bull market. The headlines are scary, absolutely. But you know what? Most years have scary headlines and some scary pullbacks, and we're still optimistic that once we get through this rough patch, which could be sooner than later, we'll still have some pretty good gains left, Jared.
You have been remarkably consistent in your call for no recession since last year. That was when it started not to come. And we want to get to our word of the day here, seasonality, because that kind of plays into our discussion. Seasonality refers to the predictable and recurring changes in data that happen at the same period every year. So, you know, we were just talking before the show, we got S&P 500 data back to 1928, before the S&P 500 existed, so to speak. Wrap your head around that. But nevertheless, you know, you can parse the data any number of ways, but sometimes there are some clear trends. And tell me how you use seasonality in your work.
Yeah, we would never blindly just invest in seasonality, but I'll tell you, it is really amazing when you look at some of these seasonal trends. You know, I mean, listen, let's talk about August for a second here.
Yes.
August, historically, when August is down, it tends to really be down, like more than any other month. In 1990, Iraq invades Kuwait. 97, the Asian contagion. 98, Russian default led to the long-term capital management implosion.
2007, quant meltdown.
2011, we had the
debt downgrade.
The debt downgrade. 2015, the Chinese yuan devaluation, and here we are now with another currency around the globe. And you know, listen. Is it random? Is it not? I don't know. I mean, but the reality is light volume. People are away in August. You get these big news events, and looking back, all those months we just mentioned were very big down months across the board, no question.
People say crash and they think October, but August is a real killer too.
When it's down, it really is. That is exactly right. And obviously we've had one of the worst starts to an August ever, kind of bouncing back a little bit. But I think that's one way to look at it. That you get these little clues with seasonality. You know, just this year, coming into this year. All right, the last 10 times you had a president up for re-election. Now, I know where you're going to next question where we're going with this, but when the president up for re-election, market's been higher the last 10 times, right? Market's doing just fine, and then we got some drama out of Washington. You could say that's kind of in the soup, so to speak, and kind of why we're having potentially a little volatility. But I think to answer your question, I think it's all about the yen. I know people think the economy's slow, and we get into that. It is parts of it. You know. The Fed behind the 8 ball, yeah, I agree. I think they are, but let's not forget we rallied last Wednesday when the Fed did its thing. The market was okay, knowing there's more cuts coming. The reality is the yen is or the Japanese BOJ really upset the apple cart with that hike that apparently nobody expected, and then here we go.
Well, so backing up a little bit, is it that August can be a little wonky? You know, from my perspective, just because it's, you know, we're almost most of the way through the year, we're kind of closing in on the start of the third quarter shortly. Is there an event that precipitates something like this, or is it just that it's the end of summer and people start doing weird things?
Yeah, I think, well, a little combination of all those, really. I mean, I think a lot of it does. Volume's usually light. I mean, you look. I mean, what were we just dealing with before all this started? I know it was in July, but I mean, or June. Let's talk about June just for a second here. The worst day in June. Remember what it was? Down 0.41%, 41 basis points on the S&P. The worst day all of June. Okay, and a good chunk of July was like watching paint dry as well. So you kind of can have that, and then boom. What we've seen throughout history, when periods get slow, there's volatility. Then you get a lot of volatility. Things get slow. So I think with that low volume, people, I mean, just on our team, I mean, a lot of people are on vacation the last week or two. It's like, oh my. I think a lot of people, I heard Jerome Powell's on vacation this week. Like maybe he's working from home, working remotely.
Jackson Hole coming a little early.
Jackson Hole's coming a little early. You better believe it. So anyway, you know, I just think it's kind of all those things together, really.
Okay.
But it's just good to know, I think. It's a good context to know.
Yeah, and then following on that, what do you typically see in an election year?
Sure.
Yeah. Well, again, it's two-sided, if you will. You know, election years on average up about 7%. But when you historically have had a president up for re-election, and again, I'm aware of what's happening right now, you tend to get a strong second half of the year. It's those lame duck years, 1960, 2000, 2008. Now, there's some big things happened in 2000 and 2008 that kind of skew those numbers. But that's just something to be aware of, and that's something we've been talking about a lot. And then you also look at elections. What do markets hate? Uncertainty, as most listeners probably know. And then you tend to get, what you really tend to get in most election years is this. A sell-off ahead of the election, okay? Just the last two elections, what did we see? 2016, 2020, good weakness ahead of it. Then the uncertainties, over, once that election's over, then you get that upward bias. And I mean, we said a month ago, if we would have done this, I'd say, you know, we'd be foolish to think we're only going to have 1 5% correction all year. That's what we had earlier this year. Ahead of an election, you're probably going to have more volatility. And I know this volatility, again, is because of what's going on probably with the BOJ. Nonetheless, you know, that's what you tend to see. So we could have, I think we can talk about the VIX volatility. There's a lot of cool stuff going on there. But I think we're trying to carve out a low, but I mean, the low is in play. And just know September in an election year is not all that great. So I wouldn't be shocked at all if we had more scary headlines with that election around the corner.
Let's talk about the data for a second. Data is actually not that bad. And, you know, we had a slightly disappointing payrolls report last week. You can knock off you can blame part of that on the weather, but also I'm looking at defaults, credit card defaults. Those are running the right way. Those are going down. And so I'm just wondering, you know, you haven't seen recession. Talk to me about the data, maybe the potential for an upswing here. Maybe that's the issue.
Well, that's our case, right? We don't think there's a recession. You mentioned defaults are going down. Look at you know, how many people are getting laid off, right? Layoffs are not spiking at all. I mean, usually you see layoffs spiking if there's a recession around the corner.
Jobless claims pretty muted.
Jobless claims, well, we had a little bit of a spike, but again, you know, a lot of that potentially was what we just saw in Texas, right? I mean, Texas had a huge spike in initial jobless claims because of the storm. So we're watching that, but again, you know, a lot of the consumer data, there's some cracks, yes, but again, it's not over the top. I mean, you think about market peaks, it's usually at excesses, right? I mean, yes, credit card debt, quote unquote, an all-time high over $1 trillion, but so is net wealth. Net wealth is up exponentially even more. So we call this denominator blindness. Yeah, you know, numerator's up, but denominator, net wealth, if you own a house, you own a house and some stocks last 10 years, you're probably worth a lot more. And then the other big thing we hear all the time is, well, inflation's up a lot and it's really hurting. And there's no question inflation's up a lot. Since before COVID, the core PCE is up about 19%. That's the Fed's
20% is not nothing.
Well, it's not nothing, but then you look at wages, you look at compensation up 25 and 26% on the whole. And you know whose wages are up even more? The lower 50%. So I'm not saying things are perfect out there, but there are some real positive, Jared, when we look at it, that we say this is overblown. One more comment, you know, we all freaked out. We all, not me, but a lot of people freaked out last week. I don't know. Right? Everyone freaked out when we had that manufacturing data last week from 300 purchasing managers that said they're not hiring, and everyone got all worked up about it. And then the jobs data came in a little wonky also, but you know, again, I think we're that you can say there's probably some weird things going on with the weather in Texas last week, or last month. But in reality, services number just came in yesterday.
Yes,
and services is really strong. Employment, new orders, business activity, that makes up a huge part of the economy versus the 10 or 11% for manufacturing. Not ignoring manufacturing, but it's like let's take the full picture here.
Talk to us a little bit about the moves we're seeing in the VIX this week.
Yeah, bite down on that.
Yeah, because that massive swing up.
Let me get a drink. Oh boy, yeah.
Massive swing up. I'm seeing right now down 6.5%, although I'm told that is the wrong way to say it. So can you also explain a bit about that?
Well, sure. So I mean, it's like a joke, I guess we use on social media.
Some people on X take it very seriously.
They do.
I took it seriously when I saw your tweet.
Well, you know, so you can look at the VIX should be looked at in terms of points. So I did it move 5 points, 10 points, because when it's low like it was recently, you can have a very big percentage move, and it's not really telling the same story. Like, oh, the VIX is up 100%. I mean, that's a big move. But again, from 10 to 20 is not the same as from 20 to 60 when you talk about volatility. Now, to get to the VIX, this is the last 3 days, previous 3 days. First time in history, going back to at least 1990, we had a VIX close beneath 30, go above 60 intraday the next day, and close beneath 30 that third day. That's never happened before.
If you watch it, you just have to laugh when you see that, because it's just ridiculous.
It really is. So
is it even useful anymore?
Well, that's a good question there. We haven't even had a 10% correction, and we got a VIX over 60, one of the highest levels you've ever seen. Now, here's again on the points basis. Yesterday, the VIX closed down 10%. That's on a closing basis, closed down 10%. That's a huge drop, an implosion of volatility. What's that tell us? Well, historically, that's really rare. All right, I'm talking like, you know, after the flash crash, after U.S. debt downgrade in March of 2020. The last 3 times we've seen a 10-point drop in one day. 1 year later, higher every time after that, and lows were pretty much formed and up over 27% on average. Not saying it's going to happen again, but when volatility implodes, it's kind of the market's way of saying we're trying to carve out that low. And it is fascinating. At the time we're doing this, VIX is 23. You know, if you just took off last week, you would have never had any if y'all looked at the VIX where it was, 23, oh, nothing happened. Well, not so much.
Mr. Seasonality, plying your trade on the VIX. I love it. VIX seasonality. All right, we need to take a short break here. Coming up, we're going to take a look at small caps looking for some sunshine. And we're also going to talk more about the VIX, which could shed a few pounds. We stir things up with a volatile Who Wore It Better? Up next. We are back and our sponsor is calling. It is the number 86. We recently had the Russell 2000, that's a small cap index, surge 5 straight days, up over 10%. And this was before the nasty sell-off we had this week. So a little context there. Ryan, you recently calculated what the Russell 2000 looks like a month later, 3 months, 6 months, 12 months, when it has that big 10% move in 5 days. It's up 86% of the time. That's our number right there. With a median gain of 19%, the average is 27%, pretty high. Not quite as bullish on the shorter time frames, only 57% positive a month out, but I think that would be welcome news for people who are staring at the short-term technicals in the Russell, which is not looking great right now. We had that break to the upside, and we're back in this 3-year range. It just doesn't look good.
No, it's kind of like Lucy and Charlie Brown on the football, right?
Yeah, that's what it feels like.
The football back, and we've had an overweight to small and mid caps for the majority of this year. Now, mid caps have done a lot better than small, but nonetheless, focusing on small, our big thesis has been inflation is last year's problem. There's going to be some Fed cuts coming, and again, we didn't see a recession. And we saw that huge spike after CPI, a few weeks ago. Sure. Came in better than expected, and that's what sparked that big 5-day, we called a buying thrust. And again, historically, those buying thrusts are kind of, they show a change in trend or maybe an acceleration of the trend if the trend is already bullish. And the bottom line, again, is it tends to be bullish. I mean, small caps really are historically cheap relative to large. There's, if you look at earnings growth, this earnings season, it's okay, and some of the large tech and AI have been a little disappointing, but small cap earnings have been solid. You look out next year, small cap earnings are expected to grow more than large caps. And we think that's very possible, again, with an economy that probably avoids a recession. So there are some drivers there, and I get it. It's kind of a dirty word to say small caps because it frustrated people. Let's not forget, the Russell 2 gained 27 or 20, either 24 or 27%. I forget the exact number, but close enough for government work. The last 2 months last year. That was the third best 2-month rally ever. I looked at the 10 largest 2-month rallies ever. A year later, you're talking up close to 30% on average, higher like 8 out of 10. My take, small caps had a huge end of year rally, went sideways for 6 months. Now potentially they're starting to get going again. And I'm aware of the rug pull that we just saw, but I mean,
I'm starting to believe here. I appreciate this.
Yeah.
Does it matter if small caps are the leader or not?
Oh, good question.
Yeah, it really, listen, I mean, I guess it depends how your portfolio is. If you're all in large caps, you wouldn't like that. But we think, to answer your question, yes, we like to see other groups participating versus just those big 7 names, just technologies, communication services. And to see that, like I know, Jared, you look at this stuff all the time, those equal weights, right? The equal weights are finally starting again to do well because, again, we know the large names in the tech haven't done quite as well. So to see some participation across the board, we like. Now, I mentioned we like small. We also like financials and industrials. On Sunday night when we were promised to crash by a lot of people, as of the middle of this week on Wednesday, the industrials and financials actually up on the week. That's kind of amazing when you look at that. And that's that leadership that we're looking for. We like the cyclical names, small and mid.
All right, so let's talk about that. You mentioned financials, industrials, healthcare also reaching new highs, all-time highs this year, at least in the large cap space. Talk about some of these other groups, because for a long time, this talk was just Magnificent 7, Mag 7, concentration worries, and then we had the appearance, and this goes back to that small cap breadth thrust that we were talking about. Looked like things were rotating, kind of got kneecapped by the yen, but talk about some of these other sectors that are participating.
No, there really are. I mean, look at year to date. 10 out of 11 sectors are positive on the year.
And financials have led at
they've led a good chunk of that.
Wait, so does this just mean you should own all the sectors?
Well, I think let's put it this way. So I get to work with financial advisors all around the country and talk to their clients. What clients love to do is chase a shiny object. Oh, tech's the best thing? Let me have some tech. Oh, that's the word, like utilities, they're terrible. That's the utilities, like one of the best groups this year. That's the worst thing, don't put me in there. So I think we say, avoid the shiny object. Continue to keep a diversified portfolio. Continue to rebalance. Just because something underloved now or loved now doesn't mean it's going to be there in 12 months. So that's kind of how we look at that. But it's a great point because, again, unfortunately, I work with clients for 25 years, and that's what they like to do throughout history, and sometimes they can't help themselves, and they make the worst decision at the worst possible time. That's why having a financial advisor sometimes goes a long way.
Sometimes the shiny object can make you a lot of money, though. So, I mean, sometimes that's the right bet, especially in the early innings. I think the problem comes when people just kind of glom on late in the stage. But what are your feelings on the AI trade and the hype cycle? We're in a lull right now. Do you think it reaccelerates?
Yeah, we were on neutral at best technology here. And you look at earnings, though, Mag 7's up 30% this recent quarter. So there's still a lot of earnings growth coming in there. But again, I think it simply got ahead of itself. Just a little too much excitement, a little bit, the world is going to change. And there are major changes coming. I'm not minimizing them. But you see what some of Google and some of the companies have said. Maybe they haven't. I mean, it's still impressive what's going on, but they didn't quite hit that incredibly high bar. It's just a lot easier to clear the bars a little lower, and that bar got awfully high for those groups. But the bottom line, again, last I checked, tech is still the largest component of the S&P 500. So you can't have that just blindly falling apart. Expect the market to hold up. But they just kind of go market neutral here. And again, that baton gets past some of those cyclical areas and other areas that can lead. That is perfectly normal, and we think it's going to happen and quite healthy.
Ryan, since I've been a participant in markets, I feel like tech has been the leader. Yeah. And Mag 7, everyone's pouring all this money in. If you're a younger investor, I don't know what kind of advice, it kind of seems like you should just pour a lot of money into tech. If you're retiring 30 years out, wait to see what happens. It doesn't seem as comfortable to go into one of those other sectors like healthcare or utilities and say all my money or most of my money is going to go there. So what do you say to that?
No, great point. I mean, let's not forget in 22, we had a vicious bear market. A lot of those Mag 7 and tech names are cut in half, down almost 70% in some cases.
I mean, 2/3 in the case of
Meta. I think Facebook was down, I believe, over 70%, pretty close there. But I think the bottom line for younger people, the advice that I have when I get to travel and talk to people is stick with your plan, right? If you truly want to invest in technology, there's going to be periods There are going to be years where they don't do so well. And the worst thing you can do is call uncle and get out and then again go chase something else. And again, that's why having still being diversified makes sense. But absolutely, if someone's younger and they're going to invest for the next 25 years, they could have geeky words like tilts and things like that. They can tilt their technology a good deal, but just stick with it because again, there's going to be times like in late 22, you're not going to feel so good having those Mag 7 names.
That makes sense.
All right, it is time for Who Wore It Better, and let me get the script. Oh, yeah, I believe this is the debut of the VIX on our Who Wore It Better segment. So indeed, the VIX has been on the move as we've been discussing, recently spiking to 65, the third highest level ever. Sometimes these panics, as seen through the VIX, they're short-lived, sometimes they persist. So today we want you, Ryan Dietrich, to tell us which market environment is wearing the volatility spike better. So going back in time to the beginning of the VIX in 1990, is it 98 when Russia was defaulting, sending US bond markets in a tizzy, and the VIX to 46, 2008 when Lehman Brothers was blowing up, sending the VIX north of 80, maybe the flash crash just 2 years later in 2010, the VIX hit 40. This S&P 500 or S&P downgrading Uncle Sam's debt in 2011. That was a year later, VIX 48. The mother of them all was recent, March 16th, 2020, when the VIX spiked to an eye-watering 82.69. And we didn't even include Volmageddon because it didn't quite get up to 40.
Right.
But which of these VIX spiking events do you think the market environment is wearing better? And it has some predictive information about where we are now.
Yeah, I think the late 90s. I think 98.
Okay.
There's some similarities there because that started with the age of contagion in 97. Now, the VIX spiked in 97, and we've got some the Asian things going on. Let's not forget, August of 2015 was, again, China devalued the yuan. That was the first 1,000-point drop ever in a Dow. Now, believe me, 1,000 points then is not the same as 1,000 points now, but that was a pretty darn scary time too. But I think the late 90s makes sense. And why is that? That's the volatility part of it. But you have to focus on other things. We are seeing, Jared, one of our good big themes. I'm glad I got a chance to remember to even mention this. Productivity. We've been saying for well over a year now, we thought productivity was going to go a lot higher. Josh Schaefer, the cool chart book he does, we shared that early in the year about expecting better productivity. Well, we saw that last quarter. We've seen better productivity for the last year and a half, almost 2 years now in our country. What in the world does that mean? Well, it's been a long time since we've had that, okay? The mid to late 90s was the last time we saw strong productivity. What does that mean? Well, Greenspan told us way back then, you can cut interest rates, you can pay higher wages, but you don't have to worry about a massive spike in inflation. We saw that in the mid 90s. We see some similarities right now. We think the Fed's going to cut. Why is everybody worried the Fed's going to cut? Maybe you see a spike back in inflation. And trust me, it could happen, but with the stronger productivity, we're comfortable saying that's not the case. And I see some similarities right there.
I have a VIX-related question because we've been talking so much about it. I feel like I've never focused on it more.
I've been talking about it in the last 3 years.
This is a great day for Sydney right here.
Who is the VIX for? Like, who should be trading options? Like, I don't really understand who should be dealing with the VIX.
Well, at the simplest way to put it, the VIX is a guess on volatility the next 30 days out. So it's for shorter traders. I mean, it is for shorter term traders. Honest to goodness, a lot of smart people I know 2 days ago when we had that big VIX spike were selling volatility. They were selling iron condors and selling puts and selling things like that without getting too geeky on this. When the VIX is low, you could say, okay, well, there could be a spike higher, but we just went 18 months without a 2% drop in one day. A lot of people expected more volatility. Now it's here, no question. But I think it's just important for your average investor when they hear the VIX, they hear someone on TV like myself or somebody talking about it. When you see that spike above 30 or 40, the VIX is a mean reverting instrument. It kind of like oil. Look at oil. Oil's like been flat. The price of gas has been flat for almost 15 years. You think about it. But the VIX is that way too. It spikes, but then it can come much lower, and that's kind of how it works. That's the average person should think of it like that.
On that, we sort of have been talking a little bit about advice for early investors. What is one piece of advice you wish you could have told yourself when you kind of started dealing with the markets?
Yeah, great question there. So I started late 90s. All right, so I was caught up in that bubble. And I lost a lot of money and made some money on the way up and then lost. But I learned, okay, bubbles happen and you get all caught up. So just always kind of remember a lot of smart people, I wasn't that smart when I was younger, but a lot of smart people can get caught up in a bubble. So if that kind of, Sir Isaac Newton, okay, he lost as you know what, and it's South Sea bubble, right?
He made a lot of money on the way up, and then he rebought at the top and rolled it all the way down.
We're going back to Isaac Newton right now.
The point, fun, playful way, but the point is that one of the smartest people to ever live could get caught up in a bubble because his neighbors are getting rich, everyone's getting rich, and he wanted to get rich and put more money in, and then I believe he died very poor, I believe.
And bitter.
And bitter. So anyway, if that could happen to him, it could happen to a lot of people, right? It could happen to anybody. So I think it's just important to remember that. But the other thing for young people, you're going to blink and you're older. I think it happens fast. Time really is on your side. Can start to put as much as you humanly possibly can in 401ks and Roths and IRAs, all that stuff, because you're going to your future self will thank the young self who wants to take that money and go see the Olympics, but you might thank yourself a lot more down the road.
15 seconds. Any final words for investors?
I just think we've gotten through this before.
Yeah.
We've had scary times before. Investors need to remember that we're going to get through this again. One final thing, earnings are still strong. I mean, earnings are still strong. Corporate America, I know AI was a little weak, tech a little weak, but other groups, look what 3M said, okay? People are still spending money. This economy is still strong, so that's going to drive us, we think, still to new highs before this year's over, Jared.
All right, we're going to leave it there. Sydney, Ryan, thank you.
Thank you.
That's it for Wealth, everyone. I'm Brad Smith. You can stay tuned for Market Domination. That comes up 3 p.m. Eastern Time. You've got much more Yahoo Finance during today's trading session.